this quick turn from markets from it's all fine and we still have growth to, oh my God, the world is coming to an end, is really made all of the markets come down.
This says it's probably much more about market positioning as it does about how much the economic data has changed.
I think we all need to calm down a bit. This is a process, and this is very natural for markets.
All in all, I think this will turn out to be more of a technical aberration in the market.
Our number one highest conviction trade for 2024 coming into the year was volatility, and we're seeing it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
One of the longest Mondays ever. Welcome to Tuesday. Live from New York City this morning. Good morning, good morning. Bloomberg Surveillance starts right now, coming off the back of the biggest one-day drop on the S&P 500 since 2022, and it could have been a whole lot worse. Your scores this morning look like this. Equity futures bouncing back by 0.4% on the S&P. On the Nasdaq, up by 0.4% also. It's goodbye margin call Monday and hello turnaround Tuesday. The Nasdaq 100 yesterday at the open was down 5.4% before pairing some of those losses going into the close. But the turnaround in the bond market, absolutely staggering. Sit on the 2-year, 395 right now. Yesterday morning at 8:30 Eastern time, 364.98, down 20 basis points on the session. And then we got this firmer than expected ISM, and 90 minutes later, that 2-year yield was positive, and that's where we closed. And we add to that move this morning, up 3 basis points on a 2-year at 395. So we had the data was better than expected, and we had some Fed speak. And I have to say, there was a real absence of fear in the Fed speak. From Goolsby on Friday with Michael McKee, with Mary Daly yesterday afternoon. Anne-Marie, we have a reasonably solid labour market. That's the takeaway from the Federal Reserve.
And what she said is we are slowing, but we are not falling off a cliff. Mary Daly yesterday, policy adjustments will be necessary in the coming quarters. So everyone who's saying about potentially the Fed will go before September, not going to happen. We have now confirmed that the labor market is slowing. They've confirmed it. They've seen the data. And it's extremely important that we not let it slow so much that it tips itself into a downturn. So once again, she's setting the market up for September, but she's not saying that the labor market has massive cracks in it and we should see this sort of exuberance we saw in the market. It's slowing, but not falling off a cliff.
I started the program yesterday by saying, let's take a giant step back. Let's do that again. Let's take a giant step back and think about, just historically, just frame some of the moves we've seen in the past 24 hours. Jim Reed of Deutsche Bank. Let's take this quote. What a once-in-a-lifetime GFC period could not do, and a liquid August day in 2024, with one bad weather-related payrolls print for fuel, did with some ease for a period of time yesterday. What would have happened if we'd have had a negative payroll print? Jim Reed at Deutsche Bank. Danny, we talked about it in Japanese equities. Everything that's happened since 1987. Everything. GFC, long-term capital management, the bust of the dot-com boom, all of that. The pandemic that lasted about 2 years. What happened yesterday was absolutely phenomenal worldwide.
It is, and it's interesting to hear the language about it today, because I've heard so many criticisms about the BOJ, saying the only thing that happened was the BOJ made a huge mistake in hiking, and that's what set off this cascading effect. I find that a bit disingenuous, because it was like this perfect storm. Sure, the BOJ hikes. You also had recession fears. You also had the AI hype. Is that too much? Everything came together, and if anything, it just showed us when the economy is slowing, it does not take that much for a rally to unwind itself.
We'll spend some time on Japan. Let's check out dollar yen just briefly. We are a little bit more positive here compared to yesterday by 0.5%, approaching 145 at 144.85. A big rally in the Nikkei 225, a move of more than 10%. And we'll get to the size and scope of that move a little bit later in the program. But let's talk about this carry trade. I've heard so many people talk about the carry trade. Danny, I got several messages on the Bloomberg terminal yesterday from people on the actual buy side, not strategists trying to come up with a reason as to why the market was doing what it was doing. People on the buy side who were saying, exactly who is in this carry trade? What is going on here? How many people are in this? How much of it has unwound? We heard this from JPMorgan overnight with our team here at Bloomberg. The carry trade unwind, at least within the speculative investing community, is somewhere between 50 to 60% complete. Do you think this is becoming sort of like an excuse, a good excuse, a reason? What is this?
I think it's people just grasping at straws, because who actually knows the size of this thing? I haven't really heard any good calculations as to how people are coming up with these numbers, because sure, you can just talk about the speculative end of the trade. You can look at CTFC futures and try to get an idea, but this thing is potentially bigger. It could potentially be, I don't know, people who are holding longer term contracts, but this all just underlines the point. We don't know, and a lot of people are unsure. There are people on Friday who said that move meant that all the shorts were washed out, and then you get yesterday. So I don't know. I just find everybody is saying something different, and there's no clear answer out of any of them.
Weaker Japanese yen on the board this morning. Let's see if that move sticks. Futures fade just a little bit. The S&P's positive by about 0.4%. Coming up this hour, we've got plenty of questions. We'll try and get some answers with Peter Tchir of Academy, following the worst down the S&P since 2022. Erik Nelson of Wells Fargo on why the moves in dollar yen are probably done for now. And Terry Haines of Pangaea Policy as the world awaits Harris's VP pick. We begin with our top story. Global equities bouncing back. Stocks rising following the worst down the S&P 500 in almost 2 years. Peter Tchir of Academy writing the following: I don't see signs of a bottom yet. While we are likely to get some tradable bounces, don't get too cute trying to buy this dip. Pete joins us now for more. Pete, good morning to you.
Morning.
Let's take that giant step back. Let's talk about this carry trade. What do you make of that just as an excuse? Is that a reason or a convenient excuse as to what's been developing in the last 24 hours?
So I think there are a lot of people who are very levered into this market. I don't know whether they borrowed in yen or what currency they borrowed in or where they borrowed, but I do sense that there was a lot of leverage positions. People were fairly aggressive in their risk positioning. That's part of the unwind. You look at all the vol selling strategies. They've all done phenomenally well. People have been piling into that, zero data expiration options. All those things are all signs of, froth, leverage. And what I think people are forgetting, to me, and I had a lot of conversations about this yesterday, is when things go up, it's fundamental, and it's my view that caused this. It wasn't anything to do technicals. On the way down, it's all technicals, these will end.
Of course.
So a lot of the reason why we got to where we were technicals, and those are unwinding, and it's a multitude of factors, and I think the carry trade's part of that, but I think it's much more just leverage and option selling, vol strategies, and people overestimating where we are in AI.
We've had a lot of shocks and a lot of scares over the last decade. So let's go through them. 2015, August, I think it was the Chinese devaluation. 2018, we all remember that December when the high yield market completely froze up here in the United States. We can go back as recently as last year when we had the banking shock, and we move on with life. You get over it and you move on. You move on quite quickly. What's the good parallel for this moment we've been in over the last week or so?
Since you mentioned, I think 2015, there was a time there was high yield, and it was getting destroyed every day. Energy was a big problem. They launched a high yield ETF without energy. That was pretty much the bottom. So I think we need something that takes away the froth here. And that's why I keep looking. It's, when we looked at ARK was really doing really well, and then it started turning over. You kept having inflows until it really got hammered. So I've been watching this NVIDIA leveraged ETF. I have no idea why it continues to get inflows, but it is. And that, to me, I look at that. I look at triple level QQQ, so TQQ. These aren't the biggest ETFs, but to me, that's kind of, you're trying to figure out where there's froth, what's the real sentiment. I have not seen de-risking. I've seen degrossing. I think some people have had to take some leverage off, but I haven't seen anything that panic. And yesterday, all anyone talked about is don't panic, don't sell. But maybe you should be selling, because I think we're going to break through the 200-day moving averages, and that could create a vacuum with this sort of liquidity.
You're talking about when the knife hits the floor. I want to talk about what happens after it. If momentum turns, and maybe that sentiment that, oh yeah, that rally was because of my fundamentals, not necessarily because of mechanics, does that disappear and we don't get the same type of rally that we've been used to?
Yeah, I think it sells off a fair bit. And you mentioned momentum, right? And so momentum had been probably the best factor all year. So momentum stocks have worked very well. And what I think we're going to really get exposed is that passive has now become somewhat of a momentum strategy, right? Every dollar that went into a QQQ or every dollar that went into an S&P fund, 50 cents of that was going to just a handful of stocks. So as those starts rolling over and people say, well, I want to take some money out of the market, they're actually going to be taking out of those same 50 stocks. So I think those same few stocks, I think that's going to propel this much lower. It's going to be scary. And we always half laugh, but everyone always says, if a stock just gets down 10%, I'd buy it here. And what people really mean is, if the stock goes down 10% for no good reason and I still have plenty of cash, I would buy it there. That's never what happens, and that's why I think there's more downside.
Okay, if there is more downside, you saw in yesterday's trade of what happens when correlation goes to 1. Basically, everything fell. There was a flavor of the bond proxies doing okay. Should we use this as a playbook for what happens in moments of volatility?
What I liked yesterday, and I've actually had sold a bunch, I liked China at the start of the year. I've been selling some. Chinese stocks actually didn't do that badly yesterday. They did reasonably well. You start looking at the Bloomberg terminal today, you've got a really good story about these Chinese brands that are making big inroads into the U.S. and elsewhere. So I think made by China is interesting. Their economy's starting to turn. So, and they were the one thing that did seem to decouple yesterday. I think it was down like 0.5 or 1% when the S&P was down 4 or 5%. So FXI is kind of one of the things I'm starting to look to. And I do continue to like energy. I was down, so we're going to start adding to that because I do think there's real risk of geopolitical events going across the globe. And every way we look at it, when we analyze it at Academy Securities, we've got a team of generals and admirals retired. It really points to oil supply shocks.
When you look at, though, buying into China, because this whole made in China nationalism with some of these brands, does that mean you think we're at the end of U.S. exceptionalism?
Yes, I think it's already becoming that. You look at some of these brands, BYD automobiles, creeping up. And so what we've looked at, we've been calling it this, I think we talked about it before, but this transition from made in China, where they made our brands, to made by China, where they've got their brands. Their big target audience is going to be a lot of the emerging markets. They have these trade deficits to a lot of those countries because they've been importing the raw materials. So China Inc. is going to be very aggressive in that. And look to Europe. That's going to be the weak link kind of in the West, and it's going to be Italy or Spain because their economies are slightly more dependent on China. Their economies are slightly more weaker. I think you had a great interview yesterday with 2 days ago with the Stellantis CEO, and they were talking about pressure that Italy's putting on them. So China's going to start using that. You look at who's selling phones within China. It's the Chinese brands are doing better and better. They're going to start exporting that, and I think it's going to be this value proposition that maybe the quality's not quite to our brands, but the price is going to be a fraction of that. And for a lot of people across this world, that's going to be a determining factor.
Can you develop an FX trade based on that?
Not really, because I think I really wouldn't trade the yuan. So I would stick more to the FXI and just keep it on the equity side of things right now.
OK, because we've seen some real dollar weakness, particularly in the last 24 hours. I got this note just months ago. I want to share it with you. What if the Fed delivers on the rate cuts that the market is asking for? Now, that's going to have big consequences, obviously, for the FX market, but potentially for the broader economy and equities as well. This is what SocGen's got to say in response to that question. If the Fed were to deliver on what the rates market is asking for, we believe that cyclical data, such as the ISM, would rise into boom territory. What do you make of that? If this market got what it actually wanted, where would this economy be?
Ooh, I think we'd see inflation right away because people would see, okay, well, the Fed's got the Fed put, we're all there. So I think you'd start seeing inflationary pressures. I think you'd see a bit of a boom. I think we'd roll over again, though. People would be like, this is... And maybe stocks have to do well, but it would be complete capitulation, I think, by the Fed. There is no reason, given how they've analyzed the data, for them to give the market what it wants. We've got to see more data. And by the time I think it would have to be such bad data, and I do think we're going to get weaker and weaker data. I think the jaw's been overstated for a lot of reasons. I think they're doing a lot of miscalculations in some of these. But then you get the data, you get the cuts, but we're going to need it because the economy's rolled over. So I don't think there's an emergency cut or 50 or 70.
I've got to ask the question, though, because everyone's stampeded to the other side of the boat. They're looking over the edge and they see this horrible shark and it's got written on it, bad labour market. And on the other side, no one's talking about inflation anymore. Do you think we're underpricing the risk of inflation picking up in this country?
If the Fed reacts, I think we would get inflation again. I think if not, it's actually become quite deflationary right now. You're seeing things roll over. You look at, I have no idea why in this day and age we use OER, right? Can't we find a better calculation for shelter? You look at anything that's kind of contemporaneous about rent, it is coming down, it's been lower, and we're still kind of basing policy off of that. Auto insurance had some really good discussions with people, right? There are no price increases coming through, and that's been one of the big drivers of CPI was auto insurance. You start looking at everything else that's coming down. Manheim Used Auto Index is one of my favorite. It's well off its highs. So I think we have this kind of chance to actually get deflationary. And my whole theory, it's been very simple, is we had two bumps. We had a COVID goods bump, where goods became very expensive very quickly when people could get their hands on it. They had all this money, it came off. Services took longer to play out because each state had different rules, each country had rules, and individuals had different preferences when you were willing to do that. So that bump played out, and now that's starting to roll over, right? Look what we're hearing from the airlines, the hotels, right? So that trade's over. I think we're on a deflationary period. People are spent out, they're tapped out of their money, and jobs are starting to become hard. No one's quitting anymore, right? I think we are really at the cusp of real economic weakness.
Sign to the labour market just freezing up just a little bit. Pete, it's good to see you. Peter Tchir of Academy. If you are just tuning in, I imagine you want the price of one thing, and that's one currency pair. It's dollar-yen, 144.63. We're just about positive on the session by a third of 1%, but that move is fading. Likewise in the equity market, so we'll keep an eye on that throughout this morning for you. Let's get you an update on stories elsewhere. We can do that with your Bloomberg Brief and Yahara Hackers. Hey, Yahara.
Hi, John. A U.S. federal judge has ruled that Google illegally monopolized the search market through exclusive deals with Apple and others to make its search engine the default browser on devices. The ruling hands the government a victory in its first major antitrust case against the tech giant in more than 2 decades. Attorney General Merrick Garland calls it a historic win for the American people, while Google says it plans to appeal. Vice President Kamala Harris has clinched the Democratic nomination for president. The virtual roll call vote wrapped up last night, and the Democratic National Committee says the vice president won 99% of the delegates' votes. Now the question is, who will join Harris on the ticket? She's expected to announce her running mate today before kicking off a campaigning tour of 7 battleground states starting in Philadelphia this afternoon. She'll formally accept the nomination later this month at the Democratic National Convention. And at least one person is hoping for a Vice President Tim Walz. Jeremy Green-Eek bought HarrisWalz.com for $8.99 in 2020 when Harris sought the Democratic nomination. He told the Associated Press he's willing to sell it and a dozen other Harris websites for $15,000. This is not a new scenario for the New York trademark lawyer. Back in 2011, 5 years before Hillary Clinton selected Virginia Senator Tim Kaine to be her running mate in the presidential race, he purchased ClintonKaine.com. That's your Bloomberg Brief. John?
Yahara, thank you. We'll see Yahara again in about 30 minutes' time. He must buy so many websites and just sit on them.
But also, if it is Governor Walz, why is it only going for $15,000? You have to imagine you can get a lot more for that.
Oh, you think he should be selling for more?
Yeah, I think so.
OK, you heard it here. All right. Up next on this programme, unwinding the yen carry trade.
Looking at the various suite of positioning metrics we have, we think that the carry trade unwind, at least within the speculative investing community, is maybe somewhere between 50 to 60% complete. So we are not done by any stretch.
More on the latest from Japan up next on the programme. Live from New York City this morning. Good morning. From New York City this morning. Good morning. Let's do this all over again. Welcome to the programme. Let's get to equity futures first. Just a little bit of a bounce here, with the emphasis on a little. It's not a big one. We're up about 0.5% on the S&P. Bond yields pushing higher on the 10-year, up by 5 basis points, 383.71. Much higher than where we were this time yesterday morning at the front end of the yield curve. The 2 years up by another 3 to about 395. Big focus on dollar yen. Just a slightly weaker Japanese yen in the mix, 144.68 on that currency pair. Under surveillance this morning, unwinding the yen carry trade.
We think that the carry trade unwind, at least within the speculative investing community, is maybe somewhere between 50 to 60% complete. So we are not done by any stretch. Some of the technical studies we've done suggest that once you get very large, sharp moves in short periods of time, like we've had with the yen, the technical damage that it inflicts on portfolios is not easily undone.
So here's the latest on this front. The yen has taken a breather following the biggest 5-day rally since 2008. Erik Nelson of Wells Fargo writing the following: the dollar yen move has been quite extreme and probably done for now. Looking ahead, we see reasons why dollar yen should continue to fall on trend after a short-term retracement. Erik joins us now for more. Erik, looking forward to spending a little bit of time on this with you this morning. I want to go to those comments from JPMorgan that we think the carry trade unwind, at least within the speculative investing community, is maybe somewhere between 50 to 60% complete. Erik, where are these numbers coming from? I think there's a lot of interest in this from people outside of this world. How big is this trade? How do we know how much of it has unwound?
Yeah, there's lots of different metrics you can look at. The number we like to look at is just in the CFTC, the futures data. It's probably the most widely available number. If you look at total short positions from hedge funds and asset managers in aggregate, those total positions have fallen about 50%. So sort of consistent with what we've heard. Now, I think there's two ways to look at this. There's looking at it in a vacuum and just saying, well, if this goes to zero, then you have another 50%, right? Maybe a better way of looking at it is, are we actually going to see a real level change here in recession concerns? Because for all the talk about growth concerns, I've talked to very few investors who really have genuine recession fears. Growth forecasts have been marked up for the global economy, looking at consensus forecasts for the last 3 to 4 months straight. If you have a genuine recession fear come through, if you start to see that in growth forecasts, that's when you can unlock the next leg of dollar yen downside. I don't think we're there yet, though, and tactically, probably we bounce a little bit.
So, Erik, we spent a lot of time talking about the Federal Reserve's role in a lot of this, how they might step in. Let's park that craziness, that silliness just for a moment. I want to talk about the BOJ. The BOJ was uncomfortable with dollar yen on the way up. How comfortable is it with the way it's moving down?
I suspect it's probably moved a little bit too fast for them. They have to probably expect this sort of move would happen, though. We know that with these carry trades, it's up the stairs and down the elevator. So it's a little bit, obviously disruptive for them. They want to see stability. Obviously, the BOJ hike a couple of days ago has probably exacerbated the extent of the move. But I certainly don't think they're at the point where they're worried about or sort of feeling the need to step in here and react to this move with actual policy action. And I'm not sure it's not necessarily going to change the way they think about policy normalization going forward. I think they probably think it's stabilized. They'll watch the market and see how things go.
Erik, you said it exacerbated the move, the BOJ hike. There's been a lot of commentary this morning that it is the root cause of the rapid appreciation of the yen, that they made a policy error in hiking when the economy couldn't handle it. What do you make of that conversation?
I think it's hard to say it's the root cause. I mean, we'd already moved basically 7-8% before the BOJ hike came through. So a lot of the move happened prior to the BOJ hike. I think that it did exacerbate it in the sense that we had this kind of sort of cross-market correlation, Varsha, call it whatever you want. Everyone was in the same trades, right? That's really what I think characterizes this market as best I think as it can be. So I think the extent we've seen, the unwind in long Japanese equity positions, the unwind in dollar yen, maybe the BOJ hike has exacerbated that risk-off move. But the root cause, I think, is maybe not. I wouldn't agree with that characterization.
So the unwind happens, Erik. What, if anything, could even take the place of the yen as a carried trade? Who's to say that people don't just pile back into this thing, given that yield differentials are still pretty large, even with the move?
Yeah, and this is the thing. I mean, part of the question or concern here is this still an environment you want to be putting on carry trades over the next few months, right? We've obviously had a level shift in the volatility environment across markets. Growth, like I mentioned, there was a lot of complacency around growth. That may start to change the next few months. I don't know that this is the environment where you're going to see people rush back in to put on carry. If anything, I think you're sort of in the opposite environment where people are looking to take off carry and looking for opportunities to do that. And that probably limits the upside in dollar yen here, unless we have a consistent several months in a row of very strong U.S. and global data where it's very evident that recession fears are unfounded. And that may be a little bit tricky to see.
Got about 60 seconds left. I've got to ask you, have you got a favourite trade right now, Erik, given how much has blown up over the last few days?
Well, I'm a little bit skeptical that we're going to continue to see this dollar weakness. You're looking at euro dollar at 110. I understand the rate differentials have moved in euro's favor and out of favor of the dollar, but I think some of the dollar weakness has been a function of just dollar yen kind of unwinds. So particularly looking at sort of buying the dollar versus some of these more growth sensitive currencies, Swedish krona, certainly one of them, even the euro itself. If we start to see that repricing and growth, that should start to weigh on some of these other non-dollar currencies.
The euro pulling back this morning. Erik, thank you, sir. Erik Nelson of Wells Fargo, the euro there against the dollar at 109.09. For all this talk about a weak dollar and an aggressive Federal Reserve, Morgan Stanley, Ellen Zentner, had this to say. We don't think payroll spells real weakening. Could be weather, could just be noise. The Fed would need, this is the interesting point, the Fed would need less than 100K in August payrolls to consider a 50 basis point cut. Mike Feroli's already there. He's going to join us on a programme a little bit later. Hollenhorst is already there. Zentner's basically saying you need a sub 100K payrolls print for the Fed to consider 50.
And I think given history, it's probably fair given the revised print in April was 108,000. I mean, we didn't freak out then and said that the Fed was going to do an emergency cut, but this time we are.
September 6th for the next payrolls report. The Federal Reserve decision September 18th, and we said on this programme yesterday repeatedly, I know that's just around the corner, but that feels like a lifetime away. Coming up on this programme, waiting on Kamala Harris's VP pick. We'll catch up with Terry Haines of Pangaea Policy in just a moment. From New York, this is Bloomberg. Live from New York City. Welcome back. Let's get to the futures. Equity futures on the S&P 500 positive by 0.6%. On the Nasdaq 100 up by 0.7%. Just a little bit of a bounce. Remember on Friday, the Nasdaq entering correction territory. The S&P 500 almost joined it, just fell short in yesterday's session, but still posting the biggest one-day drop in almost 2 years. The turnaround in the equity market is small. In the bond market in the last 24 hours, it's been anything but small. It's been large. The 2-year yield at 8:30 Eastern yesterday, Danny and me were going through it together, 364.98. We were down almost 23 basis points. And then we turn around 90 minutes later on the data. ISM services coming in better than expected. Business activity, new orders, regaining expansion, the employment component, Danny, all good, 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 tick, 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 and certainly in sharp contrast to what we heard last week.
By the way, we also got SLOOS data, which was also strong. Weakening in credit conditions, we haven't seen that. Less lenders were tightening standards. So when you ask about what demons were exercised in yesterday's trade, the recessionary one, that certainly was helped by the data. The AI one, maybe not as bad as we thought. Maybe the carry one still has room to go. And that's why everyone kind of says, is the worst over? I don't know. That seems to be the answer.
Let's talk about the carry piece of this. I think the first thing a lot of people are looking for, you sort of wake up, get out the Bloomberg terminal, Bloomberg anywhere. Is this just me? I think this is basically everyone. Check out dollar yen, see where, just me. Dollar yen looks like this right now, 144.97. I think a lot of people are waking up this morning, Danny, and they're turning to this one just to gauge where things are at over in Japan.
Yeah, when does a 10% equity rally and a 0.5% rally in the dollar versus the yen disappoint? It disappoints when the action was so big yesterday. So sure, we are turning around, but I think so many people were struck by the speed at which the collapse happened, which has people kind of rubbing their eyes saying, should I actually believe the turnaround that we're seeing? Should I actually believe this? When potentially the fundamentals could just re-up this trade. If you get any more whiffs of recessionary fears and any more whiffs that Japan is still willing to hike more.
The move on the Nikkei, never mind the yen. The Nikkei 225 had its worst day since 1987, Monday. Tuesday has its best day since 2008. That is wild, wild volatility.
It is a whipsaw of a trade, and I know it wasn't as bad in the U.S., but you still got that whipsaw. You still have seen the big AI names whip around like that with so many people who love Japanese stocks, with so many people who love U.S. AI stocks. Can you really have as high conviction when you can just get bullied around so easily like that?
Well, they should love it even more after the movie yesterday, shouldn't they? That's the price action under surveillance this morning. Global equities bouncing back in Japan. The worst day in the Nikkei since 87, replaced and followed up with the best day since 2008. In the United States, futures rising just a little bit following the biggest one-day decline on the S&P since 2022. If you're looking for data, I've got bad news for you. You're going to have to wait. We've got a trade balance. I'm not sure what that's worth a little bit later. You've got to wait for jobless claims on Thursday, 8:30 Eastern. That's the next stop for this labour market.
And it's a scary one, given what this market has done. Like, I can't imagine anyone will be going into Thursday saying, I'm going to just go full on risk and I'm going to buy everything. So I'm curious to know what the price action looks like into it. But again, I think Monday really showed us when the economy is slowing, it does not take a lot for a rally to unwind itself. And kind of the flip side of that is when the economy is strong, it doesn't take a lot for a rally to get going. We're just on the other side of that coin right now.
This was a growth scare ignited by the data, amplified by the unwind of the carry trade. As for the data, are we going to embrace good data as much as we seem to run away from bad data? I guess to Danny's point, we'll find out on Thursday. Claims in and around 250. Let's hope they come back in. If they don't, they gap higher. Do we get back into that recession mode like we saw on Friday's session?
Well, I was going to say, kind of in the morning of yesterday, I would say, OK, this market is so offsides. We've rallied so much in this bond market. Surely the bar is really high for a disappointing jobs number for that rally to continue. But we gave that up yesterday in a stunning reversal. So maybe the buying of bonds, a much lower front yield, it could still have more juice just by the very fact that it undid itself yesterday.
Light on data and light on Fed speak as well. I'll say that too. We have heard from the San Francisco Fed President, Mary Daly. This is what she had to say. The labour market is showing some signs of softening and the central bank could begin cutting rates. How much the Fed will have to cut and when, she said, will, quote, depend a lot on the incoming information. And I have to say, my big takeaway was her assessment of the labour market. She used this word softening, sure, but we have a reasonably solid labour market, was her takeaway. And you put that together with what we heard from Austin Goolsbee sitting down with Michael McKee on Friday. We'd never want to overreact to any 1 month's numbers. Look, this market is overreacted. There were people talking about these intermittent cuts. I'm not sure what that conversation was worth. But ultimately, this Federal Reserve is not overreacting based on what we've heard so far.
And they'll say they're looking at the real economy, not the market. Also, when we heard from Mary Daly, she talked about the fact that companies are slowing their hirings. We haven't seen massive rounds of people being laid off. I thought was interesting, she said slowing but not falling off a cliff. When you look at the markets yesterday, it felt like we were falling off a cliff. That's not the view right now from the Federal Reserve.
I thought one of the interesting things she also said that wasn't given a lot of attention, but I think will disappoint the doves a lot, is she said that employment and inflation are equal risks right now. There are a whole lot of people out there who say the inflation part, that's done and dusted. Disinflation, it's coming in to the window. And it's employment you need to worry about. Mary Daly isn't saying that. And this is one of the first Fed officials that flagged the labor market as a problem. I think a lot of people are going to be disappointed by the Fed's actions.
You say the doves would be disappointed.
Yes.
Daly is arguably the dove.
Yes,
and so is Goolsby on the FOMC.
True.
So if that's where they're at on the committee, I wonder where the hawks are right now. Look out for more Fed speak a little bit later on in the week. Let's turn back to the politics. Kamala Harris officially clinching the Democratic nomination to run for president. Attention quickly turning to the vice president's running mate. Harris expected to announce her pick a little bit later on today. Reuters reporting the shortlist is down to two: Pennsylvania Governor Josh Shapiro and Minnesota Governor Tim Walz. Terry Haines of Pangaea Policy joins us now for more. So, Terry, let's talk about it. Governor Shapiro, Governor Walz. What goes behind that decision? What is behind that decision to choose one over the other?
Basically, John, what it is a difference between a transformational campaign versus small ball. The reason why I say that is because Vice President Harris is very much identified with the progressive wing of the party. That's one big reason why she was chosen with Biden in 2020, frankly. So what she needs is a governor from a swing state that appeals to much more centrist voters. Governor Shapiro, I think, is the transformational pick here, and Governor Walz. If Governor Walz is picked, what that will show you is she's trying to shore up her own party and her own base. And so that seems to me to be the small ball pick, analogous to Trump and J.D. Vance.
How much do you think, Terry, that the vice president is going to be moved by what is going on within the progressive wing of her party? Do you think she is feeling the pressure? We had yesterday Bernie Sanders and Pramila Jayapal run a call. Obviously, they're throwing their weight, even if they're not mentioning him, to Governor Walz.
Well, I think that people that aren't in the middle of the pick tend to think that what they need to do is to be as loud and noisy as possible, and that will affect the pick. At the same time, I think we're really about to find out if the vice president herself is a really good politician, because really good politicians say, "What do I do to win?" Weak politicians say, how do I shore up my, the base of my own support? So, I think that's what you see in the Shapiro versus Walz pick there. And I frankly think that the Bernie Sanderses of the world here have much less influence than they think. But then they'll want to take it out on Harris in other ways if they end up with Shapiro.
When you look at the policy of these two men, can you give a sense of what each of them bring to potential independent moderate voters in swing states that are unsure about who they're going to vote for?
Well, Walz is much more a darling of the progressive side, and he's been touted by the progressive side of the party for the last couple of weeks. Shapiro has a demonstrated track record of winning in Pennsylvania, and Pennsylvania is not only a really purple state when it comes to national politics and even state politics, but it's a state that is widely thought to be the tipping point state in this particular election. That is the state that has the most impact and most ability to move the election in Vice President Harris's direction. So for that reason, I think what you're going to see here is, a Harris that is interested in winning and doing whatever she needs to do in order to bring the biggest tent and the biggest appeal to centrists that Shapiro has already appealed to, or you're going to see a move to the progressive side.
But at the end of the day, and polling over the weekend showed this with CBS News, she's already tightened the race. Do you think it really matters who she picks as VP?
Yeah, I think it matters hugely in two ways. One is, I'll insert the transformational point that I just made here. I think it shows you that she's serious and she's in to win if she picks Shapiro, number one. Number two, there's an awful lot of talk about how little vice presidents add to the mix usually. That's so, but Shapiro can help in a crucial swing state and maybe others, and that's no small thing, number one. And number two, vice presidents can have huge negative impacts on a ticket and how a ticket is perceived. We'll all remember Sarah Palin, who very quickly became a figure of fun and an anchor weighing down the McCain campaign in 2008.
Terry, forgive me for being really blunt with this question, but I kind of feel like we're dancing around it with this whole idea that the progressives might not like Shapiro. Mm-hmm. Is there just plain and simple anti-Semitism in this party that makes Josh Shapiro an unlikely pick for vice president?
I think that's much less, and I welcome the direct question. I think there's not a lot of anti-Semitism in the Democratic Party. I think you see some in specific parts of the Democratic Party. There's a large community of Somalians in Minnesota, for example. The influence of Palestinian Americans in Michigan is well known. There are some progressives who want a much more balanced view within their balance between Israel and Palestine in their own party, and more, frankly, on some levels. But no, I don't think the rank and file. I don't think the rank and file. And I don't think the vast majority of Democratic leaders are anti-Semitic at all. They're trying to balance their ticket, and frankly, that's why Shapiro. One reason I think Shapiro makes more sense in a transformational campaigns sort of way than Walz does, because he actually balances the ticket by being as pro-Israel as he is.
And could we just say, Terry, that like the math of Pennsylvania means that he needs to be the choice too?
Yeah, well, it's as I say, it's the tipping point state, and number one, so it's considered this time out the most important state for whoever wins the election. The other reason is that frankly, anywhere outside of Philadelphia, in Pennsylvania, pretty much, what you're going to have is a very red Republican pro-Trump voting bloc. The math in Pennsylvania always is that you've got to bring as much turnout in blue Philadelphia and the Philadelphia greater suburbs as possible in order to balance out the rest of the state and win. And Shapiro, frankly, brings that. So, it's another reason I think I would look for him.
Terry, I've got to take it back to basics and just ask a very simple question. What does Kamala Harris stand for? You talked about her short time in the Senate. I think we can gauge something from that. We can talk about her very short primary run. We can perhaps gauge something from that. But since then, I've got absolutely no idea. We've had 2 weeks since witnessing one of the most historic things we've seen in an election in this country for quite a while, with the sitting president dropping out of the race. And we haven't heard the vice president really answer a single question, apart from a brief moment on the tarmac following the hostage exchange. Terry, when are we actually going to start to hear what her policy preferences are?
I think, firstly, I think you'll start to hear from them at the convention. Secondly, it's an advantage in a politician to be a shapeshifter in some sense, and she's certainly proven an ability to be that. I say that with no disrespect. It's just she's weaved through a lot of different policy positions in a relatively short time on the national stage, and she's also had to be a loyal soldier to Biden in the bargain. But she has shown, she has shown no compunction about jettisoning more extreme positions and adopting more centrist positions in order to win. And a perfect example of that, since we're talking about Pennsylvania, is fracking ban, which she was unapologetically for 4 years ago, and now is already jettisoned. I expect more jettisoning and repositioning to be happening.
Looking forward to it. Terry, thank you, sir. Terry Haines there of Pangaea Policy. Terry nailed it. Liberal, moderate, pragmatist, shapeshifter. Right now, she is everything that different parties of the party want her to be, because she can be. And maybe right now that's to her advantage. How much longer that can last, I don't know. Let's see what the platform actually looks like. But before we dig deeper into the polls, we don't know what that platform actually is until we get to Labor Day and beyond.
True. I love what Libby Cantrell said last week, which is basically stay at the beach, have a cocktail. You don't really need to pay attention if you're in this market and want to know how to position yourself until after Labor Day. That's when the polls will really start to matter. Maybe we'll get more insight into her policies. She's going on a huge blitz this week. Wisconsin, Nevada, Georgia, North Carolina, Michigan. But a lot of this is going to be to ramp up that support, to get more dollars flowing in. I love that Terry Haines ended on fracking. She wanted to ban fracking, but maybe not such a good idea when you want to win an election and you have to win Pennsylvania.
Yeah, there's a speech in Philadelphia later, right?
Yep.
I imagine
with
that's
her
not
VP
going to be a position that we hear much about, I imagine.
People
Equity
like
futures,
their jobs in Pennsylvania.
Yeah. Equity futures on the S&P 500 right now positive by about 0.75% on the S&P. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. U.S. Secretary of State Antony Blinken says officials are engaged in intense diplomacy to avert a wider war in the Middle East. He says the U.S. and its allies are working to head off a potential Iranian attack on Israel, urging all parties to refrain from escalation. Tehran has warned it will respond after blaming Israel for killing a top Hamas leader last month in the Iranian capital. Elon Musk's X, formerly known as Twitter, is closing its San Francisco office. A source saying CEO Linda Yaccarino made the announcement in an email to employees. Workers will be relocated to an existing office in San Jose and an engineering office in Palo Alto. The move marks the end of X's history in the city where Twitter was founded almost 20 years ago. And Tropical Storm Debbie threatens days of rain and floods along the East Coast after slamming into Florida as a hurricane yesterday. The storm left more than 300,000 people without power in Florida and Georgia, according to poweroutage.us. The governors of both those states and South Carolina have all declared emergencies, and President Joe Biden has approved federal help. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, the good news. Bonds doing what bonds are meant to do.
Yields at the short end will stay a little bit higher, if not go pricing a little bit higher from here. So, those short-term interest rates, that short end, the yield curve for investors may look a little bit interesting. Bonds are buffering you against the sell-off in equities.
That conversation up next. Live from New York, you're watching Bloomberg TV. After 8 days of rallying, just a little bit of weakness in the bond market. Yields are up by 5 basis points now on a 10-year. We're back to about 383.71. If you're looking for a bounce in the yen, or rather in dollar yen, to be much more precise, you've got one. It's a small one. Dollar yen 144.83. So that's a weaker Japanese yen by only 0.5%. And likewise in the equity market, not much of a bounce compared to the losses we saw on the screen yesterday. It's picking up, though. We're up by 0.9% on the S&P 500. Under surveillance this morning, the good news. Bonds are doing what bonds are meant to do.
The market is now pricing a greater risk of recession, a greater risk of declining rates than we would expect, and that therefore yields at the short end will stay a little bit higher, if not go pricing a little bit higher from here. So, those short-term interest rates, that short end, the yield curve for investors may look a little bit interesting. Bonds are buffering you against the sell-off in equities.
So here's the latest. Treasury yields bouncing back from yesterday's lows following better than expected services data. James Athey of Marlborough not buying into signs of resilience and saying this: we're late cycle, rising unemployment and ultimately recession will follow, and therefore a defensive portfolio makes the most sense. James joins us now for more. So James, let's pick out a couple of your trades. Long duration, long the Japanese yen. And let's take a little step back and think about where we've been and what's happened over the last few days. We have come a long way in a very short amount of time. James, are you sticking with those trades?
Yeah, hey, good morning, John. Yeah, absolutely. I mean, I agree that, just on a short-term basis, the market does look overbought in duration terms and potentially overbought in yen terms too. Just the speed that we've seen these things move just mean technicals look a bit stretched, and so some consolidation is likely, and I think we're seeing that already. If I were a duration bear, I'd be looking at this bounce in yields and saying, wow, that is incredibly disappointing relative to the rally which preceded it. But looking further into the future, I still think that there's a mismatch between the value that's on offer in duration versus the likely destination for interest rates, and also that's without factoring in the potential for weakness in the equity market as both earnings multiples and earnings themselves have to correct to a more normal level.
Well, James, let's pick out a piece of that. Let's pick out the rates call first. What do you think the likely destination for rates actually is then? We're at 550 now. What are we coming down to? And why are we so mispriced with a 2-year already down to sub 4%?
Yeah, exactly. Well, I think a lot of people were working with the idea that the Fed would ease back to 3.5 as part of a soft landing narrative. I don't think that factors in recession at all. I think traditionally speaking, if we go back over a long period of time, the Fed likely cuts 500 basis points at least in terms of dealing with a recession. So if we do go into recession, and I don't really buy this idea of conveniently mild recession. That's not to say we have a crisis per se, but a normal recession. We'll see the Fed respond quite aggressively. And of course, we know also that the Fed is hypersensitive to financial conditions, and ultimately that means to the equity market. So if you combine those two, I think it is reasonable to see rates coming down even compared to where the market is pricing them currently.
The market did come around to the idea in some ways yesterday, James, that maybe it wasn't an all-out recession on the cards, just with that flip we had in bonds. But what do you make of the fact that equities did not flip? That equities still sold off, not huge, but still some 3% yesterday.
Yeah, exactly. I mean, I wasn't surprised by the bounce in ISM, which I think triggered the kind of intraday reversal. Very much previous month was weather affected, and we saw this earlier in the year. You got a massive miss on weather, and then it's pretty much given all back the next month. The guts of the report were probably weaker than the headline, but a bounce didn't surprise me. I think equities and the lack of any meaningful sort of participation really speaks to just how overly owned and how expensive that market and those trades are.
So how far do we have to go for equities to reflect what your call on this bond market is?
Well, I mean, I'm a little dubious of this, the narrative strand that talks about the need for a kind of permanently more expensive equity market for various reasons. So just looking at long-term average earnings multiples, you could still be talking about 25% equity downside just to get back to a sort of average earnings multiple for the US equity index. If indeed we see earnings forecasts and ultimately earnings coming down, then obviously there's potentially bigger downside there. That's in what I would call a normal kind of recessionary end of cycle environment.
James, one thing you've talked about in the last few weeks, away from this mess and all this chaos, is how little you believe the politics are relevant to this market going into November. Is that still your belief?
Yeah, it's funny, while you guys were talking about that, I was sitting here just thinking, wow, I haven't really thought about the election in the last week or so. Ultimately, of course, this stuff can and does matter. I just think, there's a lot of wood to chop before we get to the actual election itself, let alone inauguration in January and then the congressional timetable for passing legislation. So, of course, a new president can do some stuff with executive order. We've seen increasingly in recent years EOs being used more liberally to try and sort of circumvent fragmented Congress. But some of the sort of tax and spend type policies, they're going to have to go through Congress. So it's going to take time, particularly if Congress is split. So for me, the cyclical dynamics and what we're seeing playing out in front of us, that is to say growth, inflation, what that means for central bank policy, they're going to be much more relevant over the next 1, 2, 3 months. Maybe we can start to think about what January 25 looks like as we get closer to the event itself in November.
But James, when it comes to the White House, unilaterally, the president has a lot of power when it comes to things like tariffs. When will you start paying attention to potentially that part of the policy if you do think maybe it's going to be a Trump presidency?
Yeah, I mean, Henry, that's right. I mean, you go back a couple of weeks and Trump was seemingly a shoo-in at 70% implied odds if you look at something like Real Clear Politics. But of course, we've already seen that reverse. So if you'd gone all in on a Trump win at this stage, you would have found yourself having to backpedal already, because obviously we've had a bait and switch with respect to the Democratic candidate. So the uncertainty for me is sufficiently high that it's difficult to feel confident or comfortable positioning for those things when there are multiple other events that can move markets in the meantime. So yes, of course, I think if we do get to the stage where it looks like Trump is going to win, you have to start considering what the impact of tariffs is going to be. But even that, in and of itself, it's an unclear effect on a lot of asset prices, because there are other aspects of Trump's policy prescription which seem rather incongruous and inconsistent.
James, appreciate the update. As always, thank you, sir. James Athey there of Marlborough, sticking with that long yen, long duration trade, talking about how great the cyclical risks are ahead of the election without talking about the politics at all. The good news this morning are things are a lot calmer. They've settled down. We're positive by 0.9% on the S&P 500. We'll see if it sticks. The lineup for the second hour of Bloomberg Surveillance looks like this. Katy Kaminski of AlphaSimplex, Henrietta Treyz of Veda Partners, Gerard Cassidy of RBC, and Dutta of Renmac. That's up next. This is Bloomberg.
If the Fed doesn't push against that tightening in financial conditions, you will actually end up slowing the U.S. economy by more.
Once they start to go, they're probably going to be going in a series of moves. I just don't see the need for a kind of a panicked rush.
Calm is important in a moment like this, regardless of what indicator data points you're looking at.
We were talking about 2 to 3 cuts. I think I would still keep that as our base case.
The Fed has the ability to cut. We are actually in a good place from a monetary policy perspective with room to run.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Live from New York City this morning. Good morning, good morning. Here's the tat of the tape so far this morning. Just a little bit better, things improve. Calmer, if you will. If that's the word of choice this morning, I'm not sure. Let's see how it sticks. We're up by 0.9% on the S&P 500. The Nasdaq up by almost 1 full percentage point. That's the equity story. In the bond market, after a big turnaround in yesterday's session, the 2-year yield at 1 point lower by more than 20 basis points and finished higher on the session as the ISM Services Index came in better than expected. And if you want to read in Japan, here's a read of things in Japan. After 5 days of aggressive yen strength, just a little bit of yen weakness. 145 on dollar yen, positive by 0.6%. And Danny, the turnaround we've seen in the Japanese equity market from the worst day since 1987 to the best day since 2008.
And the irony is the best day since 2008 doesn't even make up for all the losses that we've seen. Like, this is when you get disappointed. It's only a 10% rally. Does this shake all those people who just love Japanese stocks, the Warren Buffetts of the world that said that things were changing? Sure, we turned around, but a lot of volatility behind it.
Yeah, then we speak to Peter Tchir, who says, don't be cute. Don't buy this dip yet. He still thinks potentially there's still more unwinding and downturn to come in this market.
We've got a big lineup for you this hour. Look out for this. Coming up, we'll catch up with Katy Kaminski of AlphaSimplex as markets bounce back from a 3-day sell-off. We'll speak to Henrietta Treyz of Veda Partners ahead of Kamala Harris's announcing her VP pick, and Neil Dutta of Renmac on the case for a 50 basis point cut in September. We begin with our top story. Stocks rebounding after the S&P 500's worst day in almost 2 years. Katy Kaminski of AlphaSimplex writing this. Long-term equity signals still remain positive, but the magnitude of the sell-off may spawn more selling as investors ponder if this is a correction or a potential sign of an impending recession. Katy joins us now for more. Katy, it's wonderful to catch up with you. What a wild couple of days in these markets. Can you just frame, you're a student of history like we all are. Historically, where does this rank for you, the last few days in this bond market?
Well, I'd have to say it was one of the bigger moves, not the biggest. I'd say March last year was a bigger move for us. But what is very interesting to me is that trend signals have pivoted to long bonds. Perhaps the long reign of the short bond trade is finally over. And you're really seeing that everyone's trying to lock in those rates before we have the Fed moving in the other direction finally. So it was definitely a historic moment.
So we've been told repeatedly about reinvestment risk, Katy, and that's what you've just sort of alluded to. People have come on this program and said to people, you need to lock in the yield that's available now, lock it in for time, because once the rate cuts come, you're going to miss out on all of this. Are you saying that what we've started to see is cash migrate from money market funds to lock in yield at the longer end of the curve?
Definitely. And some of it is, as you're selling out of equities, people are saying, well, let's lock in the rates while we have a chance. I think what's hard about bonds is they're very convex in that when they move, they can move very quickly. So it's not like you have a couple of days to watch that move. Once there's a realization that something has to be done by the Fed in the fall, people react. The markets also selling off causes people to react. So I think you're going to see, instead of smooth moves in bonds, some pretty aggressive moves. And that's what we've been seeing the last 3 days.
Well, to that point, Katy, I wonder how we should think about data releases now. If this is a market that is long, you saw yesterday a scenario where something felt like it had changed, that this market needed good news to save it, not necessarily being surprised by the bad news, but needing to constantly be saved. Is that how we're going to have to treat every data print from here on out?
I think we're going to have to be very careful because what we started to see in June, and we started to see this type of behavior in June, the truth is a lot of weaker economic data has been coming out and trickling out over time. What shocked me perhaps the most is that you saw a reaction in periods like June, but this time you saw a very strong reaction, a much, much stronger reaction than you've seen in the last couple of months, which could indicate that we've hit some sort of trigger point where the narrative from worrying about inflation has shifted to worrying about weakness in demand, worrying about economic slowdown, which is a very different narrative than what we had earlier this year.
And after that, Katy, I mean, you just saw note after note talking about a sort of systematic nature of the sell-off yesterday, whether it be in bonds or in equities. Morgan Stanley saying that those trend followers have more to go in terms of selling the equity market. How much value do you put in those sorts of signals to try to just divine where the market goes this week?
Well, the truth is positioning always matters in the market when people are very concentrated, and that's particularly the case in the equity markets. We have very concentrated positioning, extended trends that have really been very strong. There's a lot of conviction in those positions, and when the sentiment shifts, when the trends change, that always causes a lot of turbulence. So I think that's something that you'll have to watch as people try to determine, has this narrative really shifted?
When it comes to the U.S. dollar, it's been tricky. Where does it go from here? Why is it so unclear?
Oh, this is a hard one. I mean, the US dollar has been really hard. Several things. Sentiment has been shifting. Secondly, growth and the strength of the dollar based on the US economy is up in play. But you also have the issue that, really the dollar has been very tied to the hiking and easing policy. So right now, it really feels like which of these three things is going to drive the dollar going forward? And it's not clear at this point.
Does that also mean that it's unclear about where the yen goes, even though we've seen this massive unwinding of this carry trade?
This is a good point because the yen has been the most successful trend for the last 3 years. It has really been a very consistent, we're doing something different. Right now, given what we saw, it seems to have been a pivot in that this particular narrative that has worked very well for the last 3 years may be over. Means that the carry trade has to readjust. It means that all currencies relative to the yen have to adjust. And I think that people are still starting to figure out what does that mean going forward? Will we continue to see this volatility?
Katy, you're cross-asset. We've heard a lot of excuses, reasons for the moves we've seen in the last couple of days. Growth scare, unwind of the carry trade. When you look across asset, do you get confirmation of a real growth scare in commodities?
Yes, we do. And what makes me nervous is that you see a pivot in positioning very similar to what you see across past recessionary or sell-off trades. You see long signals in fixed income. You see short signals in commodities. Both of these are commonly seen when you see sort of a sell-off, risk-off trade, and they tend to be the profitable trades when you go into a recessionary environment. So I think that's something to watch because if other asset classes are warning ahead, that's something that could indicate that this isn't over yet.
So you like momentum, and the momentum seems to be behind what I would describe as a disinflationary bust. Is that the right thing to get behind right now? And is gold an outlier with that in mind?
That is a very good question. I think that right now, given the direction of the signals, we do see some deflationary type tendencies. Shorter signals in commodities may indicate weaker demand. You see long positioning in bonds at the same time, which is just a risk-off trade. So for me, that is something that is a real risk. A deflationary event while inflation numbers are trickling down over time. So I think we need to actually think about deflation and what could that mean.
Katy, perhaps in all the asset classes we've been talking about, the one we haven't hit is credit. And credit's been a weird one because in past crises, it's been credit that leads the sell-off. That didn't happen this time around. It followed on, but you did see a very wide widening of the credit spread, some 53 basis points in 2 days for high yield. And that's when we start to get those fears. Does this muck up financial systems? Does lending become more difficult? Is it too expensive for corporates to dip in? Is it too soon to have those concerns about this credit market?
I think the challenge with credit is that these things often come in small waves. And it's not always going to hit every asset class and every asset at a time. What I would say is that you start to see information coming out that we could potentially have a recessionary trade and that conditions could be too tight. That doesn't mean that it's actually percolated into the credit markets yet, but it's something to watch because as we know, in past crisis periods, we do see there's often a few indications of those prior to the event. So it's something you want to sort of be aware of, that just because it wasn't hit this time as much, that it isn't susceptible to more systemic issues should we start to see a recession or a deflationary environment.
Katy, appreciate your input. As always, Katy Kaminski there of AlphaSimplex on bonds, stocks, foreign exchange, what's happening in the commodity market as well. Danny picked up on high yield. I want to talk about credit spreads, what's been developing in credit. High yield spreads at the back end of July, 297. If you're not in the market, not familiar with these kind of numbers, on a historical basis, that is incredibly tight. So super tight credit spreads means very little credit risk in the minds of the investors that are buying this stuff. Let's park that. Let's think about the widening we've seen since then. We've seen about 80 to 90 basis points of credit spread widening in just a few weeks. Now, I get that the levels are still pretty low at sub 400, but in terms of the rate of change, the pace and the size of this move in just a few weeks, that's more than notable.
Correct. And it's concerning, again, the level you could say, maybe it's not at a point yet, which companies are saying, oh, this is too high, the cost of capital is too high for me. But when you get this volatility, you have what you had yesterday, which is virtually every single company that planned to come to the market to issue bonds backed off. There was nothing yesterday. And that's when those fears come in. It doesn't need to be a high cost of capital. It just needs to be volatile enough that corporates can't get the refinancing or just the loans that they want into this market.
So one day, if that's not a problem, if that starts to turn into a week, into a month, then you've got a bit of an issue. And that reminds me of 2018. I think we all remember December 2018 when the high yield market just seized up. I'm pretty sure that in that month back then, there was no primary issuance whatsoever in the junk bond market in the United States. If you get a month of that, then the Federal Reserve's got a role to play because this is about a disorderly moment in the market. It's not functioning properly. You have to step in and do something. A couple of days of it, it's not going to be a big deal to Federal Reserve officials. And I think that's been echoed by what we've heard so far from two of them.
Yes, and I also think that's why the intermeeting cut thing is kind of drove me crazy yesterday, because usually when they would do an emergency, it's because something was happening in the credit market, just plainly and simply because it has the most direct economic effect. And again, we did not see that yesterday. So you do need a more sustained period, to your point, because when we have seen the Fed step in, I mean, you can even look at COVID. They started talking about buying high yield and investment grade ETFs. Again, that's where the problem needs to stem from.
Yeah, not a market functioning issue yet. It could change, but, you know, we'll see. Based on this morning, things improved just a little bit on the S&P. If you're just tuning in, welcome. We are firmer by 0.9% on the S&P 500. In the bond market, yields are higher this time, not lower. We're up by 7 basis points on a 2-year, getting closer to 4% again on a 10-year, up by about 7 basis points on the session. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Shares of Uber are up more than 5% in the pre-market. The company reported better than expected gross bookings in the second quarter, underscoring resilient demand for its rideshare and delivery services. Investors had voiced concerns over Uber's long-term outlook following Tesla's announcement of its robo-taxi event in October. But Uber highlighted that autonomous vehicle ridership in the past quarter was 6 times higher than a year ago. And Palantir shares are surging after the software company raised its annual outlook. Sales for the quarter rose 27% as demand continued to climb for its AI technology. The company emphasized its work with the U.S. government and allies, including for defense and intelligence purposes. Palantir has also expanded its commercial wing, with sales rising over 30% year over year. And the Chicago White Sox hit an unfortunate milestone last night, losing their 21st straight game. They are now tied with the 1988 Baltimore Orioles for the longest losing streak in American League history. It's been a bleak season for the White Sox, who, based on their current record, are on track to lose 124 games this season. That would be the most losses since the 1899 Cleveland Spiders, which lost 134 games that season. That's your Bloomberg brief, John.
Yahara, thank you. More from Yahara in about 30 minutes' time. I'm next on the program, determining the Democratic ticket.
What she needs is a governor from a swing state that appeals to much more centrist voters. We're really about to find out if the vice president herself is a really good politician, because really good politicians say, what do I do to win?
That conversation up next, live from New York City this morning. Good morning. Lots of notes dropping into the inbox from the south side. Here's the latest from Barclays, just on the Federal Reserve. The Fed is likely to recalibrate, not panic. They elaborate. They say, we believe last week's data will push the Fed to recalibrate to a softer jobs market, not pivot aggressively. Their call now, 25 basis point cut every meeting, September through to the end of the year, 75 basis points in total by year end. It's kind of like the cooler, calmer head view of things from Barclays this morning. In the bond market, yields pushing just a little bit higher on a 10-year up by 7 basis points. In the equity market, just a little bit of a bounce following yesterday's big loss. We're up by 0.9% on the S&P 500. Under surveillance this morning, determining the Democratic ticket.
What it is a difference between a transformational campaign versus small ball. What she needs is a governor from a swing state that appeals to much more centrist voters. Governor Shapiro, I think, is the transformational pick here. If Governor Walz is picked, what that will show you is she's trying to shore up her own party and her own base. We're really about to find out if the vice president herself is a really good politician, because really good politicians say, what do I do to win?
It's the latest. Vice President Harris expected to announce her running mate later on today, with Reuters reporting the top contenders are Governor Josh Shapiro of Pennsylvania and Governor Tim Walz of Minnesota. Harris now the official Democratic nominee after securing enough votes on a virtual roll call on Monday. Henrietta Treyz of Veda Partners joins us now for more. Henrietta, let's get into this. The two decisions then, or rather the one decision of the two candidates, Governor Walz, Governor Shapiro. What do you think ultimately is the deciding factor to choose between these two?
I mean, unfortunately, I woke up this morning and restarted my phone. I had such a vivid dream that Walz was picked. I just thought for sure I'd missed a headline or something. I think the question is really which state do you need? What does Walz actually do for the ticket? I think it's maybe premature to count out Mark Kelly, a senator from a really critical swing state of Arizona, although there's a lot of tension on Walz overnight. And inside D.C., a lot of chatter around him. I think part of that comes from Speaker Pelosi singling him out. But she, if you listen to the full interview that she did with Dana Bash on CNN yesterday, she talks about all the candidates and really has a good point about how these are all good options for Kamala Harris. And the best case scenario here is that for the last 2 weeks, we've had 3 to 8 very prominent, relatively moderate or some left-leaning members of the Democratic Party coming out and echoing their support for Kamala Harris, which is really what you want going into this race.
Interesting you mentioned Nancy Pelosi. She says she has not also spoken to Biden since he dropped out. Interesting. She says that everyone's very busy. She didn't have time, though, to make herself available for an interview. Henrietta, do you think Shapiro and Walz could really impact whether or not Kamala Harris is able to win Pennsylvania?
No, I think Shapiro is 61% approval in a state that is obviously purple and that Trump has been in the lead-in for the last couple of months, though Kamala Harris has wiped away his lead there in the latest polls. I think that if a 0.4% outcome is what it comes down to, you need to seriously consider Shapiro. My concern is that it fractures the Democratic Party. The biggest rift I've ever seen in the Democratic Party is between the Israel-Gaza conflict, and the prominence of that conversation threatens to usurp any other policy position or positive developments on the moderate side that you get from Shapiro, and a 61% approval rating, the focus on infrastructure and his response to specific infrastructure needs in the state. His response to the attempted assassination in Philadelphia, I thought was exemplary, but that all gets crowded out by the internal strife within the Democratic Party over Israel-Gaza.
Well, Danny asked this question earlier, and we should put it to you. Do you think what is going on within the Democratic Party and a lot of movement with progressives to make sure it's not Shapiro on the ticket is anti-Semitic?
I think the conversation about whether or not it raises anti-Semitic issues is really the problem, because as long as we're having that conversation, it doesn't matter whether it's anti-Semitic or not. You're saying it constantly. You're bringing up a measure of his religion, of Kamala Harris's husband's religion, about the tensions within the party. It just keeps the conversation alive. One of the concerns that I have is obviously that you have severe unrest in the Middle East right now, threatening to escalate substantially, and colleges are about to get back into session. You could easily see protests erupt again. As we head into November, that's just 90 days away. I think the conversation itself is a huge problem within the party, and it's unfortunate that Shapiro exacerbates that, but it is a reality.
So you talked about one of the bigger risks, the big macro risk that's obviously out of the hands of the vice president if things kick up in the Middle East more than they already have. Another one of them, Henrietta, we got a flavor of it yesterday. Economic concerns, recessionary concerns. If those are more apparent, how much blame do you think voters will put on the vice president?
Well, I think it's a big mistake for the Trump campaign to come out and seize on a single day loss in the market and say this is Kamala Harris's fault, because as we've seen now from the surge in Japan, that reverses the next day. I mean, we've been in this industry for 20 years. How often does that happen? So I think it's a mistake to tether it to the stock market. That is what Trump likes to do, however, so I would expect that to continue regardless. But it continues to be the case that the United States economy is the strongest in the developed world, historically low unemployment, rising wages. It's going to be hard outside of one-day flashes for Trump to paint the U.S. economy in a way that is somehow exemplary and new, while we continue to have, 3% and lowering inflation and a continued steady stream of economic confidence that is very low, but improving amongst Democratic voters and moderate and Republican voters' minds. The delta between Trump and Harris on the economy is only 5 points now. That's far different than it was a year ago, with double-digit gains for Trump in that situation. That's been largely erased.
But Henrietta, when it comes to the economy and it comes to immigration, even if Harris is starting to close the polls, when you look at the polling, most voters say that they felt more secure economically. When it comes to migrants, they felt more secure under the Trump presidency. How does she talk about the economy while also differentiating herself from Biden, which when you see in the polls, they lay the blame on Biden and Bidenomics for the rising inflation?
Yeah, they absolutely did. And Biden has taken a lot of arrows for Kamala Harris and for the whole Democratic Party over the last 3 years and just the last 3 weeks since he stepped aside. What's really interesting to me is this perception in the polls that Kamala Harris represents the moderate candidate in this race. You're seeing that in the flight of moderates and independents over the Harris campaign. That's really surprising to me, because I think the Trump campaign has tried to paint her as particularly progressive and liberal. It shouldn't be hard to do. A California attorney general, San Francisco elite, San Francisco liberal. I mean, those should be pretty easy talking points. But the polling across Pennsylvania, New York, and other swing states suggests that is not how voters are seeing this. So it's a really interesting dynamic. We'll see if it holds the last 90 days.
Henrietta, appreciate your input as always. Maybe we'll be talking to you in a couple of hours once we find out who this VP pick actually is. Henrietta Treyz there, of Veda Partners. Stay tuned. Expecting some news at some point today. I'm pleased you brought up the Kamala crash thing, because I found that absolutely ridiculous yesterday. What was that about?
Well, I mean, I guess it's saying, oh, Kamala would be bad for the stock market. But literally what you're doing is admitting that Harris is doing better than Trump. I mean, that's literally what you're doing, right? To say yesterday's action was because of her, you're saying, oh, our candidate's losing.
I think the better argument would have been that a number of economists have come out and added more probability that potentially, because of the weak jobs report and what we're seeing, we could be tipped into a recession. But I don't know, the Kamala crash isn't going to work. It feels like everyone's just throwing spaghetti at the wall. But I remain steadfast in what Libby Cantrell said. Have a cocktail. Wait till after Labor Day.
I'd take the rest of the month off, apparently. Andrew Hoddenhorst coming out with a pretty bearish note. So let's get into this. Over at Citi, Andrew's looking for a 50 basis point rate cut in September. The title of this piece, it's not just one data point, goes on to say the unfortunate reality is that a range of data confirm what the rise in the unemployment rate is now prominently signalling. The US economy is at best at risk of falling into a recession, and at worst already has. Goes on to say that data over the next month is likely to confirm the continued slowdown, and that's why he thinks they're cutting 50 basis points in September. More on that in just a moment. Up next on this programme, RBC's Gerard Cassidy on his outlook for banks with rate cuts looming. That conversation just around the corner from New York. This is Bloomberg. The bounce back from yesterday's losses picking up just a bit. We're up by almost 1% on the S&P 500. On the Nasdaq 100, up by 1.1. On the Russell, up by 1 full percentage point as well. In the bond market, the turnaround incidentally started yesterday morning. Unlike the equity market, those moves yesterday morning did not hold. They turned around off the back of stronger than expected ISM services data, and the front end of the yield curve, yields ended the session a little bit higher. We add to it, up another 7 on a 2-year to 398.74. The turnaround from 8:30 Eastern, Danny Berger, absolutely phenomenal. I want to keep going back to it. We're sitting here together. We've got the yield curve making big shifts lower. The 2-year down by more than 20 basis points. And we both sit here and say, wait for the ISM. Let's see if the data confirms or denies. And the data did not confirm.
Talk about whiplash. I think part of it comes down to what Katy Kaminski of AlphaSimplex was talking about, that this is a bond market that is now long. The risks are now asymmetric in a different way. The risks are now asymmetric to stronger data because we've all whipped up these sort of recessionary fears. And yesterday was a taste of what happens when data comes in and surprises us to the upside, because we've all gotten concerned about this labor market. So yeah, we have a lot of quietness throughout this week, but I mean, next week, talk about a big week for data. I mean, I don't know what we do with that. The risks are very high for another kind of whiplash session in this bond market.
CPI data just around the corner. That's what Danny's alluding to. Let's talk about Citi, because Citi came out with this note moments ago and I shared it with you. The last line of this note, Danny, keeping a 50 basis point cut in September likely and a potential intermeeting cut on the table. A deceleration in this economy, which Andrew says is not just one data point, it's a range of data, that at best we risk falling into a recession, at worst we already have.
I understand his point. I think the one fly in the ointment is he's there, is the Fed there? Mary Daly and Austin Goolsbee yesterday both saying it is just one data point, and we don't react off of one data point. And Mary Daly also talking about the idea that it is equal risks between inflation and unemployment. Once they have their head around that, maybe they can get to 50 basis points, but they sound very far from it at the moment.
And they're the doves on the committee, Goolsbee, Daly. They're what many people consider to be the doves on the FOMC, and the doves on the FOMC right now aren't screaming, let's go 50, let's go 50. I think the Ellen Zentner note from Morgan Stanley is pretty revealing, that they believe it's 25 unless we get a sub 100k print on the August jobs report, which we won't get until September 6th. That's the latest on the bond market. I just want to go to foreign exchange just briefly and give you a sneak peek of what's developing in the FX market. Dollar yen 145.41. So that currency pair's up by about 0.8%. What you see on the screen here is a weaker Japanese yen. Dollar yen over the previous 5 days, a move of more than 6%. The biggest 5-day move going all the way back, Danny, to 2008. Absolutely whipsawed in such a vicious fashion in this currency.
And I think so many people want to know, is this over? Has the knife fallen? And part of that centers around the carry trade, because that's what a lot of us really pinned this move on, that you had this big unwind to the carry trade and had all these consequences. We talked about this, John, that those trying to pin down how much further we go, it's tough because, OK, JPMorgan says 50%. We talked about that this morning, this idea that, OK, even if you've unwound 50%, do you undo the rest of the 50? Do you stay there? All these numbers are really difficult to grapple with. And in the meantime, I mean, do you really want to touch this Japanese market?
Yeah, there's a lot of this going on at the moment, isn't there? A lot of this in the FX market. Under surveillance this morning, some top stories for you. The government getting a win in its first major antitrust case against the tech giant in more than 2 decades. A judge ruling that Google illegally monopolised the search market through exclusive deals, saying payments to make its engine the default option on phones and browsers blocked competitors from succeeding. Anne-Marie, we've seen a lot of this, and we're probably going to see a lot more.
Likely going to see a lot more. We also have the second part of this. What does this mean in terms of penalties? What is the DOJ even looking for when it comes to these penalties? The remedies Google will need to make, we're still waiting on. But this 286 document, what the judge said is Google is a monopolist, period. And I think that said a lot of the direction of travel.
You know what I was thinking about? I'm curious, OK, they can't pay them anymore. We saw from the documents it was about $20 billion in just 2022. What a coup it would be for Google if they can't pay them anymore, but Apple and Android decide to still keep Google as the default browser. I mean, that's great for margins. But also, I mean, as a user, I think I'd be really confused if one day I opened up my phone and, I don't know, like DuckDuckGo is all of a sudden the search engine that comes up.
Don't you instantly choose Google anyway on a desktop?
Absolutely.
I always go to Google.
So maybe, I don't know, maybe the strategy already worked and it's great for them.
If it defaults to Bing, I'd go back to Google.
Yeah, exactly.
Again. Anyway, OK. Comes down to who makes the better product. At least that's personal view. Maybe that's not worth anything. Let's get to this. I want to talk about the commodity market just briefly. Crude yesterday, lower, and lower even in the face of this. The United States and allies hoping to avoid a wider war in the Middle East. The Biden administration moving additional forces to the region as concern grows over a possible Iranian attack on Israel in retaliation for the killing of top Hamas and Hezbollah leaders over the last week. Anne-Marie, phenomenal to see the growth scare in markets worldwide take over this commodity market and almost park the real risk that we all have to confront right now in the Middle East.
And it is a real risk because we already have seen one of our air bases attacked by Iranian militia west of Baghdad. You had Blinken getting on the phone, according to Axios, with his G7 counterpart, saying the attack could have came as soon as yesterday. Yesterday, Biden met with his national security team, and Axios was reporting that he was told that it is still unclear when Iran and Hezbollah are likely to launch an attack. But you've seen the U.S. move squadrons into the Middle East. You've seen them keeping that aircraft carrier. They want to maintain some level of deterrence and some level of defense because they are expecting. And Iran's new president already said, for sure, there'll be a retaliation. But we're just not sure when, and we're not sure the magnitude.
Let's just draw a distinction between the two things. You talked about the timing briefly. Do we know about the character of the kind of attack, the nature of the attack that we're anticipating here?
Not sure, but potentially what we saw in April, it's going to be similar, directly targeted to send a message to Israel.
That's the latest in the Middle East. I want to turn to the latest in the financial markets. Talk about treasuries. We've talked about that briefly. Retreating after a major rally that saw two-year yields fall below that of the 10-year note for the first time since 2022. Then unwound some of that move. 398, just short of 4% on a two-year. As this bond market makes this major move, the banks have been all over the place. So in 4 sessions, we've had JPMorgan lower by close to 10%. In 4 sessions, we've had Bank of America drop by more than 11%. To talk about some of these major moves, Gerard Cassidy of RBC Capital Markets joins us now for more. Gerard, I guess what we'd love is just your initial reaction to the summer moves we've seen for some of these large-cap mega banks on Wall Street over the last 4 days, and it's been pretty brutal.
John, it certainly has been very volatile, no doubt about it. But what's interesting to me is that the underlying fundamentals for the banks are still strong. The second quarter results were good. I don't know if you saw yesterday, John, the senior loan officer survey came out and loan demand is actually picking up and the banks are easing their lending standards. And as you have pointed out here, if rates are coming down, that's going to help solve one of the problems the industry is confronting, which is commercial real estate refinancings. So it's interesting, the volatility, and we understand that, of course, because of the volatility in the markets. But if you're confident that we're not going into a hard landing, these are good buying opportunities.
So, Gerard, we've got to get into the rate story. For a long, long time, when we had rates that were super low, all we heard was complaints. Are we now saying that we need lower rates for these banks to perform?
What would be very beneficial, John, is if the front end of the curve could come down slowly. As you probably can recall, the funding costs for the banks are now peaking. At the same time, though, the cash flows coming off of their asset side of the balance sheet, think back, if you will, when they were purchasing bonds and making loans in 2020 and 2021, they were purchasing bonds at less than 1%. Well, those bonds are going to be paying off over the next 12 to 24 months. And as they pay off, they're going to be going into higher yielding securities, even though their funding costs now will start to come down as they cut the Fed funds rate. Plus, if you start to see a steepening in the curve, that's also positive for the banks.
I want to talk about another side of their business, and one they spent a lot of time in their earnings talking about, Gerard, and that is M&A. This M&A renaissance, many of them have talked about, and how much it's going to support their business and the beginnings of it. If we have more days like yesterday, if this is a more volatile market, if this is a market where credit spreads are starting to widen, is that M&A comeback going to be as forceful as so many think it will be?
It's going to be interesting because the pipelines were building up. There was more confidence that M&A was coming back. But you're right. If this volatility continues throughout the second half of the year, it makes it more difficult for that M&A environment to pick up for the investment banks. That being said, though, lower rates will make it more attractive to do deals because the cost of funding will come down. So there'll be obviously some negatives with the volatility, but the positive could be that the lower cost funding helps do deals that maybe couldn't have been done with the higher interest rate environment of 3 to 6 months ago.
Fair enough. Okay, then how do I evaluate a bank like Goldman, and I mean, you can take any of these banks, the ones that have really been pivoting towards not investing on their balance sheet, but other people's capitals, building up these huge private asset business. Is this a good environment for them or a bad environment for them?
Actually, it's quite strong. As you take a look at their trading results versus their investment banking results, I know the investment banking results always grab the headlines, understandably so, because it's always big news when a big deal is announced. But the real driver of revenues is trading, and volatility brings on more trading. So you might recall, sadly, when Russia invaded Ukraine, that quarter's trading revenues were very strong for all the investment banks. And think about what John just mentioned about volatility. I kind of believe the trading revenues are picking up very strongly for these companies. So if the volatility continues into September, we could see a very strong trading quarter for these big banks.
Gerard, Danny brought up M&A. I'd like to get a sense from you how you're thinking about how these banks are going to perform, or sectors within the bank are going to perform, based off potentially who we're going to see in the White House next year.
It's a really good question, because under the Trump administration, when they were in office from obviously 2016 to 20, it was a very favorable regulatory environment for banks. And we expect that should Trump get reelected, that kind of favorable environment will come back, and there will probably be more M&A. But even under a Harris administration, assuming she is, of course, the Democratic nominee, I would say that we'll still see probably a better environment. And the reason being is that the regulators understand that the banks can do deals and make cost-effective decisions and drive those economies of scale, but at the same time, be very supportive of their customers. And so that's what they have demonstrated in the past, and they'll demonstrate in the future. So we expect M&A for the banking industry to pick up in 2025. But if this volatility continues, that would probably put a dark cloud over M&A for the near term.
See, that's the thing, Gerard. We got to get there first. And I wonder if the attitude, if we just kind of park the volatility to the side, is the attitude of these financial institutions at the moment, we got to hurry up and get deals done before there's the election, or is it we're just going to sit back and wait until after November?
I think it's going to be depending on the deals. I don't think anyone's going to rush to get anything done before the election. These deals have to be well thought out. And obviously there's discussions probably going on outside of the banking industry and the traditional M&A markets. And it really comes down to, does it make sense? One of the big interesting parts about M&A is that the sponsors, the Carlyles, the Blackstones of the world, their portfolio companies, they have been reluctant to sell them because the valuations are not at the levels that they recall back in, let's say, 2021. And so I think the markets, up until very recently, and this volatility maybe disrupts this a bit, but up until this volatility, the markets were very capable of handling M&A activity. It was just the sellers were reluctant to sell. So we'll have to see how that plays out through the end of the year and into next year.
Gerard, just quickly again, top pick this morning. What would you buy after the recent sell-off?
I would say after the recent sell-off, John, Bank of America looks very attractive. You pointed it out, it's down 11%. JPMorgan also looks attractive, as does Goldman Sachs, all three of them.
Quite a correction in the last few days. Gerard, thank you, sir. Gerard Cassidy there of RBC, down more than 11% on Bank of America in just 4 sessions. Unbelievable. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. UK Chancellor of the Exchequer, Rachel Reeves, has declined to rule out increasing the capital gains tax. In an interview with Bloomberg TV, she warned that difficult decisions will be taken to fill a $28 billion budget black hole. She says the UK will strike the, quote, right balance on tax in the budget due October 30th. AI darling Nvidia is dealing with some engineering issues. According to people familiar with the situation, the company's upcoming AI chips will be delayed due to design flaws. The delay could be 3 months or more, affecting Nvidia customers, including Meta, Google, and Microsoft. In a statement, Nvidia says it doesn't comment on rumors, and production is on track to ramp up in the second half. Nvidia is up in the pre-market after losing 6.4% yesterday amid the sell-off. And Boeing executives are back on Capitol Hill today. They're facing the most extensive hearing yet about the fuselage blowout back in January that exposed multiple quality lapses at its factories. The National Transportation Safety Board is spreading the questioning over 20 hours today and tomorrow. Since the accident, Boeing has named a new CEO. It's agreed to buy back its supplier Spirit Aerosystems, and it's pleaded guilty to a conspiracy charge from 2 previous 737 MAX crashes. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next on the program, the Fed staying cool, calm and collected.
We've now confirmed that the labor market is slowing. We will make policy adjustments as the economy delivers the data so that we know what is required.
That conversation up next. Neil Dutta, just around the corner. Stocks on the S&P 500 up by 0.7%, just a bit of a bounce following the losses of yesterday. Yields are higher by 5 or 6 basis points. The 10-year 3.8465, and the yen weaker this morning, 145 on dollar yen. Under surveillance this morning, the Fed and Fed officials staying cool, calm and collected.
From my mind, we've now confirmed that the labor market is slowing, and it's extremely important that we not let it slow so much that it tips itself into a downturn. We will make policy adjustments as the economy delivers the data so that we know what is required. If we reacted on one data point, we would almost always be wrong.
Here's the latest. Fed officials acknowledging softness in the labour market, but falling well short of endorsing emergency policy changes. Neil Dutta of Renmac writing the following. The time for debate is over. The Fed needs to recalibrate policy now. Our call is that the Fed delivers a 50 basis point cut in September, with at least another 50 basis points of cuts spread across the next 2 meetings. Going more in September makes up for not going in July. Neil joins us now for more. Neil, I said the Fed's been cool, calm and collected. Some people watching might say cool, calm and complacent. But you say the following, and I think your note in the last week following payrolls on Friday is an important one. You said they've stepped on a nail, not a bed of nails, and you went on to say this is easy to fix. Neil, why is this so easy to fix?
Well, thanks for having me on, John. I think it's easy to fix because there's nothing structurally wrong with the U.S. economy. Everything that ails the economy is a function of tight monetary policy. I mean, nobody's talking about a troubled asset relief program. No one's talking about a resolution trust corporation. So, I think that that's important to keep in mind. What we're dealing with is simply a function of the Fed keeping rates too high. And that means that lower rates can be the solution to what ails the economy. I think for the Fed, it's important. They talk about not wanting to make one data point too important, but it feels like that's what they're doing. I mean, you already see this with the debate between 50 or 25 in September. Well, if the jobs number comes in strong for the August reading, we'll go 25. But if it does what it did last month, we'll go 50. I mean, that's ridiculous. We already know the revisions to these numbers are negative, right? So whatever the number is, it's gonna be weaker, in hindsight. And the unemployment rate continues to march higher. And we know that the momentum under the economy is weak, and we know that there's an asymmetry with respect to how firms deal with bouts of market volatility. Higher market volatility spooks them a lot more than lower volatility makes them feel good, typically. So, I just think I've been saying it, they need to get on with it. But I think the longer they wait, the more they'll end up having to do, which is why I say that not only will they go 50, but I do think they'll go at least 50 more in the final 2 meetings of the year. So that's sort of how I'm thinking about it.
Yep.
But as I say, I mean, I do think the markets will respond reasonably well to lower interest rates, and I think that will help stabilize the economy.
Credit to you, Neil. You've been calling for this for a while. I just want to pick up on an important distinction. I hear from you loud and clear what you think they should do. Do you think they are dependent on that jobs report in August on going 25 versus 50? Do you think it comes down to that?
I mean, it seems that way. Look at the Wall Street Journal this morning. They had an article talking about how the next employment report is going to basically determine whether or not they go 50 or 25. But Powell has also talked about how it's the totality of the data. What if core inflation comes out very soft in the next report for July? I think that there's a reasonably good chance of that happening, given what we know about the deflation in cars, the cracking in housing rental inflation, and the ongoing weakness in non-housing services. There's good reason to think that we'll get another dud on core inflation. So now, not only is the employment figures weakening, but core inflation is converging onto 2% more rapidly than they thought after the first quarter. So it's also about the outlook, right, John? I mean, what's the upside case for why employment will pick up? We get a weather bounce back? I mean, it's crazy. Housing is slowing. If you look at the number of new homes that have been sold that haven't been started, that's down over 30% against last year. That's going to bleed into single-family residential construction. It's unlikely that we get the kind of inventory investment rebound that we got in Q2 in the back half of the year. That's going to weigh on manufacturing, and total hours worked in manufacturing already slowing over the last 3 months. And the fact that the labor markets have slowed means what? Incomes are slowing, which will take some of the upward momentum out of consumer spending, which the Fed has been optimistic about. So it's not about just waiting for this data to come out. It's also about thinking about what the outlook might be. In my mind, the data already justify a 50 basis point move. I mean, the fact that the unemployment rate is up to 4.3%, that's 30 basis points higher than where they think it's going to be by year end. You put that into a standard kind of Taylor rule model, you get at least an additional 60 basis points worth of rate cuts. So it's not about just the data as it's come in, though they keep wanting to make it about that. It's also about the economic outlook. And, I don't think there's really a right tail for growth. I think the distribution of risks is skewed to the downside, and it's important for the Fed to neutralize those downside risks by easing monetary policy.
Yet, Neil, Mary Daly yesterday saying that risks are equal between employment and inflation. That does not sound like a woman who's ready to cut 50 basis points in September.
Well, that's what I said, and I mean, you're right, and I do think the Fed has a role to play here in trying to get on the right side of the 8 ball. But what's happening in the markets, I mean, leaving aside the sort of unwind of positionings and things, I mean, the big move in yields happened in the 2 days following the meeting. Why? Because the data was weak. The risks aren't balanced as much as they want to. This is really about them. It's not about them knowing something the market doesn't know. This is about them realizing something the market and most investors already do know. And that's why I think, you're in this point now where if you get bad data, it's going to lead to bad market outcomes, because anything at this point that looks weak in terms of the economy will kind of fuel these bets that the Fed's behind the curve.
Bad news has been treated.
The markets already know,
guys.
The markets already know that the risks aren't balanced. Whether they say it or not is another matter.
Just waiting for the Fed to catch up, Neil. It's good to hear from you. Neil Dutta there of Renmac. Appreciate it, sir, as always. Neil's framed this perfectly over the last week or so. Going into that Fed decision, you've got to ask yourself, and this was last week, before Wednesday, what is the greatest risk here? That unemployment goes higher or inflation reaccelerates? And for Neil and others, the risk is pretty clear. It's the former and it's not the latter.
I think it's fair, framing it, what would accelerate inflation, and having a hard time really getting anything that would get you there. Again, the issue, though, comes from, is the Fed just behind in all of this? Neil is talking about the Wall Street Journal, writing that they're deciding between 25 and 50. You had a Fed chair, Jay Powell, who wouldn't even say that a September cut was happening. I mean, there's this really hilarious point in the press conference where he says something like, a cut wouldn't be political. Not that we're going to cut, by the way. So, I mean, he's not even fully endorsing it himself.
Just how quickly the conversations changed. We reflected on this yesterday. At the start of July 2nd, Chairman Powell's in Sintra, Portugal for the ECB get-together, and he's talking about a strong labour market being a reason to wait, a reason, justification to be patient, to get this right. And a month later, you get that jobs report, and the conversation changes so quickly. Has it changed that much for the Fed? We'll wait for more Fed officials to hear from them. The third hour of Bloomberg Surveillance is up next. We'll catch up with Jim Caron of Morgan Stanley, Oliver Chen of TD Cowen, Kristina Campmany of Invesco, and Michael Feroli of JPMorgan. Mike looking for 50 from the Fed in September. All of that up next.
This quick
turn from markets from it's all fine and we still have growth to, oh my God, the world is coming to an end, is really made all of the markets come down.
This is probably much more about market positioning as it does about how much the economic data has changed.
I think we all need to calm down a bit. This is a process, and this is very natural for markets.
All in all, I think this will turn out to be more of a technical aberration in the market.
Our number one highest conviction trade for 2024 coming into the year was volatility, and we're seeing it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Just an absolutely brilliant, fantastic lineup of guests in the last 24 hours. Earl Davis of BMO there, long volatility coming into 2024. Well, coming into summer, that's worked out big time, particularly in the last 24 hours. Lindsay Roseman of Goldman Sachs Asset Management saying, deep breath, stay calm. The right advice. We bounced back this morning. Let's see if it sticks. I keep repeating that. We're up by about 0.8% on the S&P 500 yesterday, down 3 full percentage points at the close on the S&P 500, the biggest one-day drop going back to 2022. If you switch up the board and turn to the bond market, I'll give you a flavour of things at the front end of the yield curve. The 2-year back to about 397 after dropping into the 360s at one point yesterday, which is just a remarkable turnaround from where we were. We're up 5 basis points on the session at the moment, approaching 4% all over again. We have to talk about the data and just take stock of where we've been over the last few sessions. So on Thursday, we had ISM manufacturing. The wrong kind of read on that particular data point. Jobless claims were higher than expected as well. Then payrolls just sort of poured gasoline over the growth scare. Then we come into yesterday, and we're all talking about the same thing. ISM, 10 a.m. Eastern Time. Look out for ISM services. That's the important one. That comes out better than expected. Bond market turns around. Equities almost just sort of ignore it. Ignore everything that's taking place there. And I found that divergence interesting yesterday. Bond market recovered just in terms of where yields were. They came back into positive territory on the session. And the equity market losses stayed.
Yeah, the equity losses stayed, but at 3%. I mean, they were down, and they were down more than we have seen in quite some time, just because this equity market has been chugging along. But we've been talking about this idea that you get a VIX go to 50, you have equity futures in the morning sell off some 4%, and everyone that came around this table said, be calm. Everybody in this market was, for the most part, calm. So have we really had that capitulation moment? Probably not.
Well, I'm just looking at also what Andrew Hollenhorst, and you brought us that note up this morning. He does not sound calm about where the economy is going this morning. U.S. economy at best at risk falling into recession, at worst already has. He's not even just talking about 50 basis points in September, which we just talked to Neil Dutta about. He's talking about the fact that there is this potential on intermediate cut on the table. Could the Fed move before September? What kind of data do we need to see in the next few weeks for the Fed to come out and make some emergency cut?
One of two things. You need to see massive moves in the market that become disorderly, stop the functioning of credit. We talked about that briefly and reflected on the experience of December 2018. On top of that, you'd need to see the data absolutely collapse. Basing that on Thursday and Friday, and on a couple of days of price action, I find it to be a massive stretch, and I think a lot of people agree with that view.
Well, so 2 things. 1, what would that do to Fed credibility if they decided to do an emergency cut just because the market fell? 2, what would that do to the yen? I mean, what would that do to the whole thing that really whipped this thing into a frenzy? If you get the Fed to cut, presumably the carry trade unwinds, I don't know, whatever the rest is we have in it, and you get appreciation, and then stocks sell off, and this whole thing just starts over again.
Yeah, it's a massive feedback loop. It's sort of been feeding on itself, on each other. Those 2 stories, the growth scare back into the unwind of the carry trade, back into the growth scare, etc., etc. We've seen it repeatedly. The good news, I guess, over in Japan is that dollar yen is higher. It's back to 145, which is interesting because a few weeks ago that was a problem when it was at 160. They were uncomfortable with the move higher, and now they're comfortable with the move lower. I don't know where the BOJ is on all of this. 145.12 is where dollar yen is. That's positive by about 0.5%. Just want to reflect on what's happened in the Nikkei 225. Japanese equities all over the place. Yesterday down by 12.4%. Worst day since 1987. Today higher by more than 10%. Best day since 2008. And Danny, you touched on it. The unwind of the carry trade. How big is this thing? How much more needs to be unwound? How much more should be unwound? JPMorgan taking a stab at things. The carry trade unwind, at least within the speculative investment community, is somewhere between 50 to 60% complete. That was in a conversation we had overnight on Bloomberg TV. I wish I was a part of it because I've got no idea where these numbers come from and what it all means.
Right, because I also saw numbers on Friday saying that if you look at CTSC data, it looks like it's pretty much done, and then you get a day like Monday. So part of the problem also is not even just the carry trade itself, but trying to understand what things are connected, because we decided pretty quickly that it was connected to big cap tech, that a lot of people were using it to fund the tech trade. And again, that's another beast we don't fully understand. So in trying to decide when it's over, you kind of need to know those things to get your hands around it.
It's fair to say we've got a lot to figure out. Coming up this hour, Jim Caron of Morgan Stanley as futures bounce back from a 3-day sell-off. Kristina Campmany of Invesco on why she's still negative on the US dollar. And Mike Feroli of JPMorgan on why he thinks the Fed is going 50 in September. We begin with our top story. Stocks rebounding from a 3-day global slump. Jim Caron of Morgan Stanley saying the sell-off is a correction rather than the start of a bear market, writing the magnitude is not unusual, but the speed at which it's happening is. As long as we have a soft landing, then we think the sell-off represents a reset of prices, a buying opportunity, but cautiously, patiently. Jim joins us now. Cautiously, patiently. Jim, let's get into this. Did we learn more about positioning than we did about fundamentals in the last couple of days?
Absolutely. I think that this move in the market has a lot more to do with positioning, over leverage in some cases, volatility, than it does the economic fundamentals. And look, you were just talking about it on the show. I mean, we have a yen carry trade that's going through. We have, other crowded positions. Now, we have to recognize that the markets were in a period of very low volatility. I mean, the VIX, just a month ago was somewhere around, 11 or 12. 24 hours ago, it went to 65. And effectively, that is a significant move which causes people to de-risk very quickly. So the low volatility period allowed people to build very crowded positions and actually get rewarded for them. So I think what stops this, and this is always the question mark, is when an asymmetry starts to appear, meaning that there's more upside risk than downside risk, or the upside and downside risk components balance. Where is that level in the market? It's hard to say, because like you were saying, that there are many of these positions still probably need to get unwound. So yes, we may have a reprieve today. Yes, we may bounce back today, but that only may give people the opportunity to sell again in order to get their positions and their volatility more squared. Even if you look at the put-call ratios in the equity markets and everything, I mean, we're talking about moves. I mean, you said it earlier. I mean, we had 1987, for the Nikkei, type of a move, and then 2008. This is like the stock market crash of '87. This is the financial crisis in 2008. These are the types of moves we're having today. I don't think the economic fundamentals justify 1987 or 2008 to justify these moves. And I think what people are looking at is they're looking at these moves and they're extrapolating from these moves a fundamental economic story. I think the fundamental component of this is very slow moving. Yes, things are slowing down. Yes, policy rates are high. Yes, the Fed's likely to cut rates this year, but I don't think it necessarily derails, where we were before. So I think that this is somewhat overdone. Doesn't mean that we can't go down, but if it does, I still think that we are in more of a secular bull market. This is not the start of a bear market, and we are going to be looking at opportunities to add to risk. In fact, what we're doing on our team at Morgan Stanley Investment Management is we are going on we're creating our list, right? We want to shop on sale. We want to find many of the positions that we weren't able to get into that have run away from us to high prices that might be on sale and might be looking interesting. So there are opportunities out there, but you've got to be cautious, patient, don't do it all at once.
Let's unpack some of that then. What's on sale right now, has been on sale over the last few days, that you've dipped your toe into, that you like and have started to buy?
Yeah, well, I mean, one of them has just been broadly the Nikkei Japanese equities. I mean, that's one. Now we were long that. Now, don't get me wrong. I mean, we got long that in March of 2023, so we've been riding that up quite a bit. But, like anything else that goes up, we weren't long enough. So, with some of the setback, these are things that we started to take a look at. Other things like some of the semiconductor stocks in those sectors start to look relatively interesting to us. Looking at factors. So thinking about quality. So we like to think about buying quality, but at a reasonable price. So this is, these are balance sheet factors, strong balance sheet companies, and high quality factors, interest coverage, things like that, are just looking more attractive today, where even if we want to broaden out our portfolio, diversify it more away from large cap and big tech, I think that there are some good segments of the market and some good quality factors that are out there that actually represent that can actually represent an opportunity. Now, what I do think is a little bit overdone, though, to fund some of this is a bit of the move in the interest rate markets. I think the bond yields have priced in Fed cuts going down to 4%, maybe even 3.5%, depending on how you want to look at it. I think the bond market has moved quite aggressively. And even if you look at the bond market from point to point, if we look at the start of the year this year, 10-year Treasury yields were about 4% on January 1st. Today they're at 3.85. Okay, so clearly there's been move up in yield in between then, and now it's come back down in the speed of the move. But point to point, the bond market is actually relatively steady. It's giving you a nice little coupon, and returns are up around 3% in fixed income, which is okay, right? And this is kind of what you want. But the point, though, there is that most of this right now, most of the return is now coming from the yield move lower. And I think that might be a little bit on the overdone side. So we may fund some of our equity positions by selling some of our bond positions because interest rates went down so much and the prices appreciated quite rapidly.
So if we're in the secular bull market for equities, bonds have moved too far to 3.85. What is more reasonable, Jim? What's sort of an analogous trade to what you see on equities?
So, I mean, the way that I kind of think of it is as a range type of a trade. So for me, the level 5,200 in the S&P 500, represents the beginning levels that you would want to start to think about buying. And the reason I say that is I key everything off of what I believe is a level that's more fair for equities today. If I look at the S&P of around 5,350, and that's roughly 19.5, PE. That's a 19.5 multiple on 275 earnings pulling forward from 2025. So if I think about the overshoot that we've recently had, that went up to 5,500, 5,600, and I think about that more symmetrically, it tells me that 5,150 to 5,200 on the downside from that 5,350 center actually starts to look relatively attractive. So today it would look like we're a little above that. But like I was saying earlier, with this rally in the market, what this may do is it may give some of those positions that still needs to be unwound the opportunity to sell into some of the strength, and they could push prices back down. But that's where the asymmetry begins. Around 5,200, around 5,150 in the S&P 500. I believe the upside potential for markets relative to the downside, even if you have a deeper correction in equities, becomes more symmetrical. So that's where I start to pull out the buy tickets. And that's what we're looking to do at this point. Now, if I thought we were in a secular bear market, and if I thought this was going to be the start of something really big, no, then I wouldn't do it. I mean, I would think that, the downside has a lot more room to go. But that's not where we are. In my view, I think the economy is cooling. It's not collapsing. Yes, earnings may start to slow as forecasts come out, unemployment rate rises. There's less strength from the consumer. Certainly that's going to be a little bit of a drag. But, in many cases, I still think that the jobs market is going to maintain, relative strength. The people who are very bearish on the bond market, or I should say on the equity markets, are people who believe that the unemployment rate is going to 5-6%, right? That we're going to have this major adjustment higher. There's going to be this big layoff spree that's going to come through. Right now, layoffs aren't actually showing any real meaningful acceleration. Yes, temporary workers aren't being rehired as quickly, and there is some softening in the labor market. That's good for the Fed because it lowers wages, and lowering wage inflation keeps inflation down. But I don't think necessarily it's an overall collapse in the market. I view it more as a normalization. And we have to draw that distinction. Is this a significant negative change, or are we just normalizing? And I think we're more or less normalizing at this point, but there's going to be overshoots to the downside, and I think those overshoots can represent buying opportunities.
And yet, Jim, here we are. I want to squeeze this in because I think this is so important. You say that what we've learned in the last few days is we've learned more about positioning than we have about fundamentals, and I think a lot of people might agree with you. I just want to reflect on what another Jim said earlier this morning over at Deutsche Bank, Jim Reed. What a once-in-a-lifetime GFC period could not do, and a liquid August day in 2024 with one bad weather-related payrolls print for fuel did, with some ease, for a period of time yesterday. What would have happened if we'd seen a negative payroll print? Jim, I've got to ask this because I just wonder how fragile this market actually is. So if you're saying this is just normalisation and nothing nefarious, I wonder what happens to this market when we do have to confront something more nefarious. Just how unstable are things, Jim?
Yeah, listen, I think it's a good point. I mean, if we have a material deterioration in the data, then I would argue that, yes, I mean, maybe there is something bigger that's going on. So if I compare that to many of the crowded positions that are likely still out there, look, we could have another 5 to 7% downside correction. It's not uncommon to have about a 10% correction in the equity markets. I mean, this is kind of a normal thing that, that happens on a regular basis. But that, I think that kind of misses the point. I mean, if we start to get something in excess of a 20% correction, that's typically the signal where a bear market might be starting, or there might be something bigger that's actually taking place. But right now, when you look at corrections, 8, 10%, 11%, which is what we've roughly had over the past 48 hours, let's say, Monday and Friday, this isn't something that is overly unusual. And I think that we as investors need to be patient, and we need to take this in stride a little bit. And that's why I keep going back to this, right? We have to ask ourselves a fundamental question. Is this the start of something bigger, and is this a bear market? Or is that what's happening right now? Are we going to see an absolute collapse at this point, and sudden stop in economic activity?
Yeah.
Is that what's happening right now? If it's not, then I still think that the bull trend is intact, and we want to be able to find places to buy.
Got it. Jim, enjoyed this. Thank you, sir. Jim Caron there of Morgan Stanley. His view on what's been happening and where he wants to be. Up next on the programme, the Morning Calls. Plus, we'll catch up with Oliver Chen of TD Cowen on the state of the consumer. That conversation is just around the corner. Counting you down to the opening bell, 1 hour and about 10 minutes away, with equity futures bouncing back just a bit. We're up by 0.8%. Let's get you some morning calls. First up, D.A. Davidson raising its price target on Palantir to 28 from 24. The analyst citing growth acceleration due to persistent demand for AI solutions. The second call from Morgan Stanley lowering its price target on shares of Amazon to 210 from 240. The firm removing Amazon from its top pick list following last week's, quote, disappointing results. And finally, TD Cowen raising its price target on shares of Walmart to 80 from 75. Analyst Oliver Chen saying the company is well positioned to continue momentum across a leading retail tech ecosystem. That stock is up by 0.25%, and we're lucky. Oliver Chen's in the studio with us. Oliver, good to see you, sir.
Great being here. Thanks, John.
Does Walmart win and everyone loses? Is that what's happening here?
We're excited about Walmart because it's both defensive and offensive. On the defense side, it's a leading grocer. Everyday low price is a key strategy. On the technology side, there's a lot happening to compete against Amazon, including digital marketing, as well as advertising and marketplace models and platforms. So thinking about technology married with the basics of retail and features such as curbside pickup and getting a higher household income customer. And it's a low beta defensive idea in this very choppy market.
I wonder, as people trade down, if they trade down even more, and how big of a threat is Temu, Shein, some of those kinds of names to Walmart's business?
Yeah, you're bringing up a great point. So consumer discretionary, unfortunately, has been in a recession for over a year. Temu and Shein are spending a lot on advertising. That's impacting Amazon, and the consumer discretionary trends are negative at both Walmart and Target. But it's a smaller percentage of total because Walmart is about 60% food. So we're watching that, and that's been happening. Target is more vulnerable. Target is also less expensive at 13 times relative to Walmart at 25 times. But there's a revolution taking place, ultra fast fashion, and what these new business models are doing are something the whole retail industry is watching.
Do they have the capability to catch up to that, to go on these trends that seem to change week by week of what people tell you to wear on TikTok?
Well, Walmart's getting more fashionable, doing movies and upgrading the fashion. They have a huge opportunity to sell you more than just basics, more than just underwear and fashion. They're also upgrading private labels. So new labels like Better Goods has a cauliflower crusted pizza. We're just looking at that. And so we're seeing Walmart really intensely focus on merchandising. That's a big positive too. Also, they're getting a higher household income customer. And we see that in our survey data too, because you don't even have to go in the store. You can get on the marketplace, you can also get Apple products and Burberry Goddess, the fragrance. So we're seeing this whole transformation with merchandising getting more competitive, but Walmart really rising to the occasion.
If Walmart is taking some of these higher end consumers, where are they leaving to go to Walmart?
Well, they're taking share from many places. So I think trade down is occurring as customers think about value and appreciate value. What's happening generally in supermarkets, it's quite fragmented. So the most pressure is at local chains and non-national and others.
Are we starting to see this stress migrate to higher income earners? Because we're starting to see some bad results from luxury.
Yeah.
And I'm not convinced it's just execution from the Guccis of this world. It seems to be pretty broad. What are you seeing from the luxury players now?
We're cautious. So our only big idea here is LVMH, which is a $90 billion revenue company. But the big caution factor is China and the property market, and that customer is so important. The other factor, correlations are quite tight to the S&P 500 performance. So the negative headwinds from the wealth effect on this pullback are going to be something to watch for sure. And we see weakness in bridal trends. So we're cautiously optimistic. However, we're out this morning with a note on retail's reset. And we like structural long-term growth opportunities on the pullback, including LVMH, ELF Beauty, and Ulta. Beauty's been a good sector.
I'm just thinking of certain consumers, certain companies that have started to pivot to premium over the last few years. It's all we've heard about coming out of the pandemic, and which companies are going to be caught offside. The demand's just not going to be there. Who's vulnerable?
Well, we're still watching Caron. You know a lot about the Gucci brand. That's a brand in transition. And we've talked about this before, stealth wealth, quiet luxury. These no-logo trends, they're really working. So there's winners and losers. We're most excited about LVMH, the powerhouse brands, Dior and Louis Vuitton. They spend $10 billion in marketing. That really matters. And Arnault really protects his brands for the long term with very little discounting. Gucci's a brand in transition, so we're hopeful. And Cartier, we're not recommending Richemont, but hard luxury has been more timeless generally. And thinking about timelessness is a key factor of what new generations really care about.
Do you like LVMH because they have a service component? It's not just luxury goods. They also have hotels.
Yeah, I think the future is experiential and thinking beyond just collecting stuff. The core of the business is fashion and leather, but service and these fabulous stores that are much like churches around the world to these brands are part of the magic. And luxury does have to be emotional and offer you really that post-purchase, pre-purchase, and the whole transaction being very special to really overpay a lot for great stuff.
Are people not getting married? What's up with bridal trends?
It's been a tough compare. So bridal's been tough, and that's been tough on Tiffany.
I was just going to say.
It'll happen. I mean, people will love each other and get married.
Thanks,
but people are younger generations are generally getting married a little bit later.
Yeah,
it's something we're watching, and many ways to express love, from travel to other things.
Very true.
And the blueberry pound cake at Costco, we love Costco
That's
too.
another way of expressing love. People will still love each other. Thank you, Oliver Chen of TD Cowen. You know, after a sell-off like yesterday, you just want to hear someone say, you know, people will still love each other. Oliver Chen at TD Cowen just moments ago. If you missed that, I'm not sure you want to rewind, but the good news is people will still love each other. Equity futures on the S&P positive by 0.6%. On the Nasdaq up by 0.75%. This is your bounce. In the bond market, an unwind at a move yesterday started at about 10 a.m. Eastern time, following a better-than-expected ISM services print on Monday. Yields are higher still, up by 2 basis points. On a 2-year, got close to 4%. It's backed off since then from earlier this morning. On a 10-year, up by 4 basis points to 383.33. And if you turn to foreign exchange, of course, you want to know where dollar-yen is. So here it is, just short of 145, 144.75, up by 0.4%. You've heard that phrase, the carry trade, a lot over the last few days, haven't you? And Danny, we're still trying to work out just how much of that is left to unwind.
Yeah, JPMorgan says we're 50% of the way there, but I think if you ask anybody, they'll have various figures for how much further we have to go. And I think it makes people nervous in this market because, sure, you can have a 10% bounce in the Nikkei, but it does not go anywhere it needs to go to undo the biggest fall since 1987.
A 10% bounce after a 12% drop. All of that in 24 hours. I thought Jim Caron at Morgan Stanley was great moments ago. Jim made the point that what we've learned in the last couple of days, we've learned more about positioning than we have about fundamentals. Now, if you agree with that, OK, fine. But what have we learned about market stability, resilience? These moves are so big, so large. And I keep going back to what's happened in Japan. If we can sit here and say this is the largest move since, and then say something like, you know, a year like 1987, which I know is all notable to what's been developing in Japan, particularly in the late 80s. But to sit here and say that we saw something take place in Japan on Monday that GFC couldn't do, that the pandemic couldn't do, that all these events in the last 20 years couldn't engineer ignite, and yet we saw that off the back of one hike at the BOJ, some bad data, and a Federal Reserve that might cut at some point the next month or so.
I think part of the problem is we got really used to a world where the economy was growing and missteps could happen, and you can kind of paper over it because you say things are all right. If you're on the flip side of that now and things are slowing, it gets harder to paper over that. I think the same goes for corporates and the kind of punishment we've seen from corporate earnings. When things are slower and you do something wrong, you are more likely to get punished for it, again, versus another environment where maybe you could look over it.
We've seen some very, very gappy moves in this market, that's for sure. Under surveillance this morning, just a recap of some of the top stories out there at the moment. Vice President Kamala Harris set to announce her running mate ahead of a rally in Philadelphia tonight. It's her first stop in a 7-city tour of battleground states. Reuters reporting the shortlist is down to Pennsylvania Governor Josh Shapiro and Minnesota Governor Tim Walz. Now, I have to say, it'd be pretty awkward if they're in Philadelphia and it's not Shapiro.
Well, that's why everyone immediately came out when she was announcing this is where she's going to have really her kickoff rally going to be in Pennsylvania. Everyone said, well, that means it's going to be Governor Shapiro. And you heard from her campaign saying, don't read too much into the scheduling. They just had to make the schedule. She's hitting up a number of spots this week. But I imagine it'd be pretty awkward for Governor Shapiro if, you know, he gets shrugged off and the big unveiling of her VP is with Governor Walz from Minnesota in his hometown.
I'm so pleased you both picked up on the issue. What's holding this up? Because this felt like it was the clear favourite for about a week. You asked the question about anti-Semitism on the left. Is that what's holding things up? Is it something else? What's behind this decision to stall somewhat?
You have really seen this very left progressive base get whipped up into a frenzy, having nicknames like Genocide Josh. I'm sorry, how can you look at that and say there isn't some anti-Semitism playing in here? I think Terry Haines made a good point that, you know, perhaps it's actually a balancing force to Kamala Harris because you have someone who's very pro-Israel. But does that imply that Harris isn't pro-Israel? Part of the problem comes back to what you've been talking about, John. We kind of don't know where she stands.
Well, she has tried to differentiate herself from Biden when it comes to what is going on in Gaza. The Democrats, though, do not want to give a reason to progressives to have protests on the street outside the DNC in just a few weeks. This goes back to what Steve Eisman said. They do not want to have a repeat of the late 1960s when the convention was failed and there was chaos. But what you see from Shapiro, someone strong on Israel, to Danny's point, does this mean actually Kamala Harris isn't the moderate that some are thinking she is? She's actually left.
We don't know is the answer to that. Is it Kamala Harris that ran in the primaries in the Senate? Is that who we're talking about here? Was she always just a shapeshifter who was trying to get re-elected, get elected, and run for the highest office in the land? Which one is it?
Well, we've already seen some key issues like fracking. Obviously, you cannot win Pennsylvania if you're on the record saying, I will ban fracking. The campaign has come out and said, this is what she said when she's running in the primary. The campaign has come out and said, no one wants to do that. She's not thinking of doing it. So I'm pretty sure anything she said in the past that doesn't bode well for the Electoral College of today, her campaign's going to back away from.
Shapeshifter.
As of now.
Terry Haines of Pangaea said exactly that a little bit earlier. Let's get to the earnings. Shares of Uber trading higher in the pre-market. The ride-sharing company reporting better than expected gross bookings in the second quarter. Earnings continuing throughout the week with Disney and Warner Brothers Discovery due out tomorrow. The good news, I guess, is that we have got some decent earnings.
Yeah, we certainly do. And some of it, I mean, kind of bodes well for the consumer. If people are willing, to forego public transportation and take an Uber instead. One of the things in their earnings was that their ad business is doing really well. They're doing in-app advertising now, exceeded a run rate of $1 billion last quarter. I'm sorry, are we going to have ads in everything? Netflix is now an ad business. Uber is now an ad business. It's like everyone has kind of like given up on everything else and just saying, we're going to show you a few ads and make money from that.
Have you noticed how many political ads we're starting to get as well? Going into November. Just getting a headline here just on the politics. So this is what we know so far from AP. Anne-Marie, the Vice President has decided on a running mate. Have we got any detail on who that running mate actually is?
Doesn't look like we have the name, but that she's actually decided. I wonder if their reporting is now, or she really did make the decision this morning, because we actually saw yesterday, a lot of people on Twitter were talking about all of these massive SUVs leaving the governor mansion in Minnesota because he was going to a campaign event. One thing to watch out for, the second someone is tapped as a VP candidate, before the world knows, the Secret Service will know. And they will see a heightened amount of security around that individual.
So look out for that. That's the headline just dropping moments ago. According to AP, the Vice President has decided on a running mate. We just don't have the important detail for you, which is who that running mate actually is. We'll keep an update on that for you when we get one. We'll bring it to you. Let's get to this news right here from the San Francisco Fed President Mary Daly, acknowledging the labour market is slowing, but saying, quote, we look at the totality of the information before we act. The focus turning to Thursday's jobless claims data. To look ahead to that, Kristina Campmany of Invesco. Kristina, it's good to see you. Wild couple of days.
It's been a crazy few.
Super wild. Have we unwound this long dollar yen, short JGPs, long Nikkei story yet? Have we done all of that?
I don't know if we've fully cleared through it, but I think broadly across all of these markets, and we've seen like this gutting of positions in equities, in credit, in currencies, has been a positioning story. And I think to Jim's point earlier, Neil, it's not the fundamentals of just Friday's payroll report. Yes, we've seen some slowing. We know we're going to see some slowing, but this is much more, I think, about positioning. I think we're cleaner. Is it the end? I'm not sure, but...
Let's go with that word, cleaner. If we are cleaner, where do you want to step into? What do you like based on these moves following the storm of the last couple of days?
Yeah. So we've kind of been in this camp that we don't think long-end duration across most developed markets has offered value. And I still think that case holds, that we don't want to be involved there. And the extreme of this rally has been too much. I mean, certainly we were a bit on the wrong side of that, given how much we've run. But you think about the front end, to hold twos here, it's negative 11 basis point carry in 1 month. I think a lot of duration has been purchased at bad levels. So then we go to where do we want to own? We think there's value in inflation bonds. We think there's value in break-evens that have really lagged in this move. And I think it can play in both cases if, in fact, you do have much weaker growth and a recession, which is not what we're calling for. We think the Australian bond market offers some value. And I think broadly, we still think that the dollar should be weaker and that there's some value in currencies.
Well, to this point, if there are value in other currencies, if the yen isn't your carry trade now because of all this, what is? Realistically, can anything take its status as the funding currency?
Look, I think the popular funding currencies out there were the yen trade and CNH in China. And I think Japan as a whole, is it just the one hike from the BOJ or the second hike that's doing it in this 15 basis points? No, I think it's the totality of the positioning with the Nikkei and short JGBs. And you bring back to we've had 1987 type moves in the Nikkei and whatnot, but is part of it, we've gone, in the last 10 years, the US has had full cycles, and only now in the last 6 months has the BOJ hiked 25 basis points when the Fed has had multiple cycles. So you finally have had this engagement into the Japanese market, shorting rates, finally getting long the Nikkei. I think that explains part of the extremity of the moves.
And to your point, a 25 basis point hike. If we start to see a real cycle, I mean, already there are people calling for the BOJ made a mistake. They shouldn't have hiked whatever. But if this is a real cycle starting, is there even more offsides that we have yet to discover for something we haven't had for a long time?
Yeah, I still think there's value to owning the yen here. And I think because it's been so unfavored because of the carry status of it, and you can make up for that carry elsewhere. And we think, again, like when we have a focus in emerging markets, and when we look at a lot of the fundamentals in these emerging markets, there's still value. You have things like MXN that has been blown out in large part because of these cross MEX yen positions. And so things have overshot. Are people falling over themselves to get back into these carry currencies? I don't think yet. But do I think 6 weeks out, we have stability and those are still okay places to own? I think so.
You said earlier that potentially we haven't seen the full unwinding of what's going on with the dollar yen, the carry trade. When will we know?
I don't think you know until it's over, right? Like they're emotional markets, and I think you have to say, where are the levels? What can we do? Again, same thing if you look at equities. When is it over? When have you had enough? Is this extreme? We've had a lot of, in the last 3 sessions, these calling for intervening cuts, and is the world ending, and all of these things. Equities, as of yesterday's close, we're still broadly up 10% on the year. So like, I'm not an equity expert by any means, but like, seems you're still having a reasonable performance year to date.
I'd love to get to your world and talk about credit just briefly and have a chat about what's been happening with credit spreads. High yield spreads were super tight. A few weeks ago, sub 300, now approaching 4. Danny was talking about some of the issuers that have had to step to the side, particularly in the last 24 hours. How do you see things developing just on the technical side of things? How many suppliers are going to come? How many issuers will come into this market to issue supply in the next few days? What's that going to look like? Are they going to step in and try and lock in some of these yields now before things start to gap even wider?
So I think, of course, with the volatility of the market, you'll have a quieting of supply and people waiting for a bit of calm. And today, knock on wood, it seems like we have a little bit more calm, certainly, than the last 2 days. Again, my particular focus isn't credit, but when we look broadly and when we think about it, the health of the overall high yield market, when we look at companies and names, is a much healthier basket post-COVID, post all of the refinancing that went on in that period. So you had high yield that was exceptionally tight and has repriced a bit. But again, I feel like there's a lot of this panic about people talking about things falling out of bed. In reality, CDX high yield is still trading at 104. In December, we were trading at a 99 handle, 98 handle. So again, I think when we put into context where we are, I think there's a lot more panic in the market than is warranted. Probably.
It's levels versus change. The change has been impressive. The levels are still pretty decent, I guess. Kristina, thank you. It's good to see you.
Yeah, of course.
Kristina Campmany of Invesco. It's always the change that gets the headlines, right? You know, and we've seen some vicious change in the last few days.
Yeah, and a vicious change is enough, again, to like spook suppliers to come off the sidelines. It's not enough to say, again, to your point, that the world is falling in, but it is enough to do some damage. And we still need to grapple with what the lasting damage of that might be.
The world is not ending. And as Oliver Chen said, people will still love each other. So it's like therapy this morning. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. U.S. Secretary of State Antony Blinken says officials are engaged in intense diplomacy to avert a wider war in the Middle East. Blinken says the U.S. and its allies are working to head off a potential Iranian attack on Israel, urging all parties to refrain from escalation. Tehran has warned it will respond after blaming Israel for killing a top Hamas leader last month in the Iranian capital. Tropical storm Debbie threatens days of rains and floods along the East Coast after slamming into Florida as a hurricane yesterday. The storm left more than 300,000 people in Florida and Georgia without power, according to poweroutage.us. Governors in both those states and South Carolina have all declared emergencies, and President Joe Biden has approved federal help. And the Paris Olympics continue today with 2 elimination games for Team USA. The women's soccer team takes on Germany in their semifinal, while the men's basketball team enters the knockout stage against Brazil. There's also plenty of action in track and field, with St. Lucia's Julian Alfred looking to follow up her win in the 100-meter final with gold in the 200-meter event. The U.S. is tied with China atop the medal table with 21 golds, while the U.S. has the most overall medals with 79. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, setting you up for the day ahead, plus the argument for a 50 basis point rate cut in September with JPMorgan's Michael Feroli. That conversation up next. "43 minutes away from the opening bell. The scores look like this. Equity futures positive by 0.3%. Got to keep an eye on this. This move's fading just a little bit. Yields are higher by 3 or 4 basis points. The 10-year 3.8258. The move fading a little bit in dollar yen as well. 144.54. We're backing away from 145. It's still a weaker Japanese yen. It's nothing like the strength we've seen recently in that currency, but we're starting to unwind some of the mover this morning. So the move's fading as we get closer into the cash open. Counting it down to the opening bell, looking ahead to all of this, your trading diary set up as follows. Vice President Kamala Harris speaking at a rally in Philadelphia with her yet-to-be-named running mate at 5:30 p.m. Eastern Time. Tomorrow, earnings from Disney and Warner Brothers Discovery. Thursday, another round of jobless claims. Plus, we'll hear from Richmond Fed President Tom Barkin. All of that to look ahead to, plus Michael Feroli of JPMorgan saying he thinks the Fed will cut by 50 basis points at both the September and November meetings, followed by 25 basis point cuts at every meeting thereafter. Feroli adding, from a risk management perspective, we think there's a strong case to act before September 18th. Michael Feroli joins us now for more. Mike, wonderful to catch up with you, sir. It's been far, far too long. Let's get into that call. Not the 50. I want to talk about the bit before that. From a risk management perspective, we think there's a strong case to act before September 18th. Michael, just explain why.
So I think even as of last Thursday, the Fed was probably behind the curve. I think obviously the news on Friday further adds to that. Now, I don't think they will cut in our meeting unless we get, I guess it's possible if we get a bad jobs report in early September. But right now, I think, if risks are close to balance on inflation and employment, they should be closer to neutral. So that would be at least 100 basis points lower from here. So I don't see why you would want to take your time getting back to a place where you can better address both risks to inflation or to employment should those risks materialize.
Michael, there's been lots of conversation about this, about should they do an emergency Fed cut, should they go 50, should they go 50 again? As I know those two 50s are your point that John laid out. What should they be doing with QT and all that?
QT, I think that's kind of on a separate track right now, and I think the decisions on QT will be mostly determined by liquidity conditions in the interbank market. So I see that discussion occurring mostly on a separate track from where we are now.
Okay, fair enough. Let me give you kind of the devil's advocate to why you shouldn't go 50. And this comes courtesy of Apollo's Torsten Slok, who's been talking about this for some time, that just before Friday, the narrative was that this is a soft landing, that the totality of the data showed a GDP growth at 2.8%. You still have strong showings of people up at airports. Retail sales have been strong, and the labor market is not slowing to a point where it looks like it might become nonlinear. Therefore, there is no rush to cut and no rush to cut in a big way. Why is he wrong?
Well, look, I think policy is restrictive right now, and restrictive policy is appropriate when inflation risks are abound. And right now, I think inflation risks are coming down and employment risks are rising. So I think you want to get back on sides and again, taking your time to get there, I don't think is optimal given what we're seeing, again, in both inflation and employment.
Michael, just to be clear here, this call then is independent of whatever we get from the August jobs report.
No, I do think August jobs are going to matter for this. I think claims are going to matter. But I think you would have to have a pretty nice turnaround in almost all the activity data we see to make the case for going slow.
Mike, appreciate the update. 50 basis point call for September. Thank you, sir. Michael Feroli there of JPMorgan. Just getting some breaking news. Anne-Marie, over to you.
Well, CNN's reporting that Minnesota Governor Tim Walz is the one that has been tapped for Kamala Harris to be her running mate come November 5th. This is the governor of Minnesota. It's an individual, Jonathan, that really has a really interesting background. former National Guard officer, a former congressman, and a former teacher, and of course, a former governor. And he's been an effective communicator. He was the one that first said that Trump and J.D. Vance are, quote, weird. And the Kamala Harris campaign really jumped on this. The Gen Z really jumped on this. So he's the individual that she has chosen to be her running mate in November, someone that she thinks can potentially bring in moderate independent voters. But this was someone that the progressives wanted because they didn't want to see Governor Shapiro on that ticket.
So a couple of things. This is CNN reporting, not seen it confirmed by the campaign just as yet, but this is the latest from CNN. When we get an update from the campaign, we'll share it with you. Let's just separate two things. I want to talk about the decision that's been made here, if this is the decision, between going with him versus going with Governor Shapiro, and then talk about how this is an advantage for them as you start to look at the Electoral College and the map going into November. Why this guy? Why not Governor Shapiro?
So it looks like for someone like Minnesota Governor Walz, he is seen as someone who can effectively communicate to the rural America. He has this rural American charm. A few weeks ago, there was a video that really went viral of him wearing a military-style baseball cap, ammo cap, and a Springsteen T-shirt, but didn't look like he was trying to placate to everyday Americans. Looked like actually this is who he is. He speaks normal to America. So this is someone that I think she thinks can help with the Rust Belt, even though Minnesota is blue. Governor Shapiro would have been a pure play for Pennsylvania. And this evening, she's also kicking off her rally in Pennsylvania, but it's going to be with this man who, it's a 2.5-hour flight from Minnesota to Pennsylvania. He's going to be flying over and joining her, not Governor Shapiro.
Yeah, potentially awkward. And I can't but wonder, Anne-Marie, when we knew that Trump chose J.D. Vance, we had all this stuff we could say, like we know his policy, we know how it might affect Trump. Do we know that with Walz, what his views might be that impact Kamala Harris's policy?
Well, a lot of people say he's actually governed more to the left, even though he is able to win, like when he was in Congress, he was able to win a very red district. He is governed to the left. But a lot of things he's going to talk about is things like all children in Minnesota going to these public schools, having breakfast. Things like this, everyday concerns of Americans, are things that he's worked on in Minnesota and that he's going to want to talk about on this ticket.
So this is all signal. We need to start talking about substance and policy. We need to get away from just campaign rallies and talk about sitting down and actually communicating what your views are on key, important subjects for this economy, for foreign policy, and a whole range of issues. We're going to start to get some of that from the campaign in the coming weeks.
Well, we hope. There's no longer an excuse for the campaign to not put Kamala Harris in that setting. So, of course, this week she's going to go on this blitz. These are rallies. She's going to be talking to her own voters, not across from a journalist that are going to try to nail her down on what actually are your policies, because we have seen her shift and flip a number of times. So they have this week a blitz across the United States on key states. Then it's going to be the DNC convention. After that, it's really time for her to start to hammer out and discuss where she sits on these policies. And we'll see if we can get some debates in the mix in the month of September as well. We'll see. TBD. Just to confirm, this news coming from CNN, Minnesota Governor Tim Walz tapped as Kamala Harris's running mate. That coming out of CNN today, not from the campaign just as yet. If we get confirmation from the campaign, we shall bring it to you. That's the latest on the political front. I want to talk about the markets going into the opening bell. If we can just reset and get the market board up and check out equity futures, because last time we looked at this just moments ago, the move was fading, and it has faded just a touch, Danny. We're up by about 1/3 of 1% on the S&P. Looking at bond yields, they were higher, just up by 3 now to 382. And likewise, the move in foreign exchange, dollar-yen, was close to 145 when this program started, now back down to about 144.60.
Well, you'd hope that maybe if basically the big sell-off was over, you'd have more people coming in force. And I think this gets to some of the fears out there that perhaps the whole thing hasn't unwound, the fears of not really understanding of how you even measure how these types of things unwind. So the bounce isn't a huge one, but has something shifted in the sentiment now? Has something shifted that you are more likely to sell, that you are more likely to buy bonds, and what you need is convincing from every data point that what isn't what you should be doing, which is, what we got yesterday with the ISM in the bond market.
There's a bit of a vacuum here, isn't there? It's a bit of a dry patch for data for Fed speak. You won't get much data through the next couple of days. The next big one is jobless claims on Thursday, and not much Fed speak is scheduled either between now and the next week or so. CPI, of course, about a week away. Coming up tomorrow, here's your lineup. Nouria Rabini of Rabini Macro Associates, Michael Dada of Roth MKM, Mohammed Al-Erin of Queen's College, Cambridge, and the Disney CFO, Hugh Johnston. That's quite a lineup for tomorrow morning. From New York City, good morning. This was Bloomberg Surveillance.